Chris Meekins of Raymond James writing, the reality is that despite that Trump may want to be true, he is very limited in what he can do. Chris joins us now for more. Chris, welcome to the program. We're familiar with the problem, the price disconnect between the US and the rest of the world. What do you make of the remedy down in Washington, D.C.?
Yeah, I mean, the reality is during Trump's first term, he was really all bark, no bite on drug pricing. There were a lot of headlines, there were a lot of news, there was a lot of talk of how prices are going to be paid. And then even after he left office saying, look how much he lowered prices, which wasn't particularly true. So the question becomes, is he going to use the tools that are available to him, and he has some, to lower drug prices, or is he going to continue to just talk? And yesterday's executive order was a lot of words on a page. Not really sure it will result in any real changes to what Americans pay for pharmaceuticals.
Chris, this program's very popular in the Middle East. If the president was just sort of tuning out of the lunch he's in right now and tuning into Bloomberg surveillance, what would your advice be? What tools are available? What policy levers could he pull?
Well, the beauty of my job now is my job is not to make policy. When I was working at the Department of Health and Human Services, or as a chief of staff on Capitol Hill and a health policy advisor to a physician member of Congress, my goal was to try to help them formulate policies that would be in the best interest of the country. I think all Americans agreed that what other countries pay compared to what Americans pay does make it feel like the U.S. is having to carry a greater portion of the load. But when you look at what Congress has given him the authority to do with regard to Medicare negotiation, there's a lot of options available to him for how he goes about implementing that negotiation process for Medicare for those limited number of drugs. But at the end of the day, if you want to do the big stuff, you got to get Congress on board, and I just don't think they're in a position where they're going to give him additional authority in this area.
Chris, is this one lever, though, that is going to be pulled, the idea of negotiating with Medicare and possibly even with Medicaid to bring prices down from drug makers, if not some sort of wholesale shift in the way that the U.S. is charged?
Yeah, so the Inflation Reduction Act that President Biden signed into law gave Medicare the ability to start off at 10 drugs, then 15 in 2028. They will be able to negotiate the prices for 20. President Trump cannot unilaterally change the law and increase that number. He cannot unilaterally and be in accordance with the law negotiate prices in Medicaid. But Medicaid already gets best price in the United States. And so when we look at this, there's a lot of talk of what he wants to do and what he would like to be so, but there's a process. And Article 1 exists, which says the Congress shall, and gives a lot of authority to Congress. And the presidency is not Article 1, it's Article 2 of the Constitution. And that is inconvenient for someone that wants to make real changes for the American public, but that is the system that the founders established.
How much are the buyers of pharmaceutical stocks fully aware of this and not discounting at all the idea that anything really comes through that can meaningfully reduce their profits from U.S. sales?
Yeah, I mean, look, they're aware of this. They don't care whether the money comes from overseas or whether it comes from Americans. They just want the revenue targets to hit and the return on the investment that they've made in these companies and in the biotech companies that are developing these really innovative treatments. America is the biotechnology leader of the world. So investors realize that, but if you look at what performance has been year to date, we're about 10% below what is the traditional multiple for these names. And a lot of this has been the fear over what President Trump may do. However, yesterday, right after the executive order, you saw the pharmaceutical space rally, you saw the XBI rally, and the reason was they realized, like I did, that, you know, when you look at the substance of this, it was a little light.
Hey, Chris, appreciate the update from you, sir. Chris Meekins there of Raymond James. And speaking to what Chris is saying was the move in the market anyway. The fact that some of these drug makers actually rallied off the back of the announcement, I think, spoke to some of this.
All bite, all bark, and no bite, given the fact that ultimately he can't really do that much. It's not maybe the lack of desire, it's maybe the lack of ability.
Lots of news elsewhere, so let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Goldman Sachs says the Buy America trade may be back. The firm now sees the S&P reaching 6,500 in the next 12 months. That's 300 points higher than its previous estimate and about an 11% gain from yesterday's close. Goldman had cut its S&P 500 forecast twice in March, citing higher recession risk and tariff-related uncertainty. Meanwhile, the U.S. is projected to lose $12.5 billion in travel revenue this year. The World Travel and Tourism Council telling Bloomberg visitor spending is estimated to fall 7% versus a year ago. The decline in tourism is attributed to a strong dollar, some lingering COVID-era travel requirements, and a shift in people's views due to President Trump's America First rhetoric. And in sports, the New York Knicks are one win away from the conference finals after beating the Boston Celtics in Game 4. Jalen Brunson had 39 points and 12 assists, while Celtics star Jason Tatum suffered a serious leg injury after scoring 42 points. Elsewhere, the Minnesota Timberwolves are one win away from the next round after beating Golden State. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, making a fair deal.
This is a pause down to 10%. I'm not saying that they're going to go up, but it would be implausible that they would go below 10. We have to have a fair deal for the American people.
That conversation up next with BlackRock's Mike Parr, live from New York City. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
lot of banks pushing back rate cut bets. We saw it from Citi, from Barclays, from JP Morgan, this from Goldman. We expect the Fed to begin a series of 3 cuts later than we had previously expected. They now look for that to start in December versus their previous expectation of July off the back of the trade truce between the US and China. So some big changes for rate cut bets in the past 24 hours. Big changes to this equity market as well. Big rally yesterday by more than 3% on the S&P. This morning, we pulled back by just 0.2%. Under surveillance this morning, making a fair deal.
This is a pause down to 10%. We will be working to see where their final reciprocal number ends up. I'm not saying that they're going to go up, but it would be implausible that they would go below 10. We have to have a fair deal for the American people. Tax, trade, and deregulation all coming together at the end of the year.
So here's the latest this morning. The US and China are agreeing to slash tariffs for 90 days as investors look ahead to CPI data out in just under an hour's time. Mike Pyle of BlackRock and former advisor to President Joe Biden is writing the following. While tariffs will impact growth and inflation, the underlying health and resilience of the US economy and corporate sector are still strong. Mike joins us now for more. Mike, good morning.
Morning.
That resilience is something we've underestimated repeatedly coming out of the pandemic. Do you see us doing the same thing all over again?
Well, listen, I think one of the stories of the year has been how big and how frequent the swings in sentiment have been. And yet sitting beneath that sentiment has been, just a much more kind of constant set of fundamentals. And that fundamental picture does look like one of, ongoing U.S. corporate health, ongoing U.S. corporate strength. And I do think that against that backdrop of huge swings in sentiment, that underlying resilience is something that has been underestimated.
How stable do you think the hard data will be in the coming months? There's been a huge debate already around this table this morning about whether we should ignore the incoming information based on the fact that some of it has been implemented off the back of what we've seen over these talks over the weekend.
Listen, I think that the next period of months is going to be really interesting. I mean, I'm hopeful that we're going to get a period where we have some greater stability in the policy backdrop for 2 to 3 months, where sentiment is going to be more stable. And hopefully that's a window that gives us the beginnings of a real read on how this still pretty considerable shock is going to flow through to the economy. It's going to be hard in the first month or two because there is going to be a lot of noise, but over 2-3 months, I think we should begin to get a picture of just how considerable it is.
What's your expectation for what the contours of the ramifications of this shock look like in the real economy?
Well, certainly that picture looks better than it did on April 2nd, looks better than it did even 36 hours ago. But, on balance, and I think we've heard this from the Fed as well, it does mean somewhat slower growth. It does mean higher inflation, at least in the short term. And I think it does mean that, the tariffs that do remain are going to have to be absorbed either in prices or in margins. And that changes the outlook for what we can expect in terms of growth and profitability here in the U.S.
Right after April 2nd, there was a discussion about a structural change in investment. The idea that suddenly people wouldn't want to go into dollar-denominated assets in the same kind of way if you had a different framework for trade entirely. Have we put that GD back in the bottle? Has that discussion been put to bed in your mind?
Listen, I think that when it comes to the dollar, as it comes to a bunch of other moves in financial markets, again, I would just emphasize we saw huge swings in sentiment. And I would always want to distinguish between perhaps the way in which we were overly positive on U.S. exceptionalism coming into 2025 and then overly negative on U.S. exceptionalism coming out of April 2nd. I think the reality is, the dollar is at the center of the global financial system. That is an extremely sticky phenomenon that's been a part of our backdrop for decades. That being said, I think when you look at the picture overall, you see the likelihood of ongoing twin deficits, those fiscal deficits still being high, likely the trade deficits being high in part because of those fiscal deficits. And that on balance, I think means the dollar is likely to be on something of a weakening trend, but nothing like a change in that basic fact of the dollar being at the center of the system.
Mike, just to build on that, to finance that deficit, to encourage international investors to come in, quite simply, there are 2 ways. Either that dollar gets weaker or yields need to come up. How do you see it?
I mean, I would say a little bit both and, plus that ongoing corporate quality, corporate resilience still being sufficient to attract capital from overseas. So yeah, are the pressures on the U.S. Treasury curve likely to be higher, particularly at the longer end? Yes. Are the trends around the dollar relative to the strength we've seen in the past handful of years likely to be weaker? Yes. But there is a lot of appeal to U.S. denominated assets still, particularly in the corporate sector, and I think that's why we expect to see ongoing flows and positivity around U.S. equities from here.
There's been a big question mark on that over the last month, and we talked a lot about the push dynamic, policies here in the United States pushing capital out abroad. What about the pull dynamic? Are we doing the right things in Europe to attract that capital and compete with the flows that have been going over to the United States for much of the last decade plus?
Well, so I'd say two things. I'd say, one, I think Europe is in some ways the flip side of that sentiment fundamental story that I'm telling about the U.S. We saw a big change in sentiment around Europe. Europe couldn't have been less loved at the end of 2024, couldn't have seen a bigger shift in that short-term sentiment coming into 2025. But that's different than has the fundamental picture in Europe changed. Yes, we've seen some steps forward. Yes, Germany has stepped forward on fiscal and on public investment, but there's some longer-term changes around competitiveness, regulation that need to happen. I guess the one additional point I would make is there's a lot of uncertainty out there right now, and I still think the environment for taking big directional bets is probably a hard one. That doesn't mean go into cash. It does mean be thoughtful about where you're looking for return, where you're looking for diversification. And I continue to think that more market-neutral strategies are the place where investors should be looking to go to find those things against a backdrop where directionality is hard.
So what does market-neutral mean at a time where some of the offsets to risk might not work in the same kind of way?
Yeah, so I think one thing you've seen a range of strategies, a range of portfolio managers do at BlackRock is take advantage of volatility markets. What do we know right now? Volatility is heightened. What do we know? This is a market that's primed for reversals. And so, Rick Reeder's been talking about, at the nadir, selling puts into that moment. Now that we've come out looking to sell calls, using strategies to generate alpha that takes advantage of the fact that this is a market that has a lot of volatility, a lot of reversal, and pulling alpha out of it.
I wanted to finish on Europe. Are you worried about the Europeans in these trade negotiations?
I think it's going to be a hard negotiation. They're a big economy. They're a big trading partner. Both sides have a lot of leverage points against one another. And I think that's going to mean a pretty hard-fought negotiation. I don't know where it's going to land, but it is one that I'm keeping a close eye on because I don't think the fundamentals set up particularly well.
When the president was speaking yesterday, it's the one thing that jumped out. He's meant to be talking about an executive order addressing drug pricing in America and managed to switch to Europe, calling them nasty, and in some cases, many cases, nastier than the Chinese.
And saying, we have all the cards, and, basically they need to give us something really big. Who is they? And this is ultimately the problem that Scott Bessent put out there. They don't have that collective bargaining type of oomph. And without that, how do they even come to some sort of agreement with some really thorny issues like the VAT tax, as well as some of the restrictions on U.S. tax?
I still don't understand the issue with the VAT tax.
I don't either.
Because it doesn't discriminate against domestic or international product. Everyone has to pay it.
It's just something that seems unfair in a calculation that has to do with goods deficits, that doesn't include services deficits, that people are kind of struggling to.
Is that something about revenue collection? Is that what that's about?
It's about non-tariff barriers that make things more expensive than they seem on the surface from their prices. This is my interpretation. I'm doing my best. You look like you're confused.
I'm still struggling with it. I don't think they've done a great job of articulating the actual issue. Do you understand it?
I think that it's clear that the administration views the VAT as a non-tariff barrier. It's not obvious to me how I should think about that conceptually.
It's not obvious to me either. The way I hear the president talk about it, I think he sees it as the US companies are being punished and the European companies are not being punished in quite the same way in the US. That's the way he talks about it.
There seems to be this bigger animosity, and it has to do around autos, it has to do around agriculture, and the sense of why are our eggs not good enough for you? Why are our chickens not good enough for you? And it seems like it's rooted in some really personal disputes over standards around health and food and other things. I will just say anecdotally, the food in Europe does taste better, but don't tell anyone I said that.
The you sounded personal. I eat the eggs. Mike does too. Mike Pyle of BlackRock. It's good to see you, sir.
Good to see you.
Thanks for dropping by. Coming up on the programme, Emily Rowland of John Hancock, Tom Fawley of Maxim Group, Tiffany Wilding of PIMCO, David Kelly of JP Morgan. CPI, inflation data, 34 minutes away.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There are so many angles to this tariff and non-tariff as we reconsider what this pause means.
The shock of the tariff announcements has clearly, weighed upon international investors.
We now have the market saying, well, maybe the growth outlook is not that bad.
The question is, how are the headlines going to progress from here?
It's certainly too early to declare all clear.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. In the equity market on the S&P 500, a small move lower. We're down by 0.1% on the S&P 500, following a major move higher, up by more than 3% in yesterday's session. The focus now turns to the data kinder. We'll get to the kinder in a minute. CPI data at 8:30 Eastern Time. Retail sales on Thursday. Let's deal with the kinder, because most people assume you could now ignore the data for the next several months.
It's going to be incredibly messy, having both pull forward as well as push back types of ramifications, influences, as well as this question of how much is this backward-looking data at a time where policy has been moving faster than any real-time implications for the economy can be tracked. Here's what we're seeing from Wall Street. Across the board, they are downgrading their expectations for inflation because of the tariffs coming down from China, and they are also increasing their expectations for growth. In other words, pushing back when the Fed is likely to start cutting rates. So is the threshold now higher for the Fed to cut if you don't have some of the downside pressure potentially on growth?
Is there some tension in that view? As you said, they're downgrading their outlook for inflation and pushing back their view on when the Fed starts to cut interest rates. Is there some tension there? Does this reopen the door for them to consider, as you've pointed out earlier this morning, the right kind of rate cuts?
Right now, all I can say is there's tension everywhere, and to try to come up with anything cohesive that feels definitive is absolutely impossible. So absolutely, there is tension here on many levels. There's a question of, if you lower inflation, you're lowering it to what? From where? Okay, maybe the worst case scenario is not there, but don't you have some sort of inherent implicit increase in inflation over the medium term if you have companies that are able to pass it along, and tariffs that aren't nothing, they're bigger than they were before. And then on the flip side, you are going to have a growth hit. It might not be recession, but you do have a growth hit that might not transpire in the employment data in the same way that gives the Fed the chance to cut rates. You put this together, what do you get? It is a soup. It is a wait and see. It is difficult for companies to really know how to proceed.
I just struggle with this idea that the trade war makes it difficult for the Fed to cut and the trade truce makes it difficult for the Fed to cut.
I think you're not alone. There are a lot of people who are saying that the Fed is still going to cut significantly. Interesting, Andrew Hollenhorst, and you mentioned this earlier, and I thought that it was a good thing to bring up. He talked about, we now expect the next rate cut in July with risks balanced toward a further delay. So this idea that if they don't go again, there is the risks on both sides that's one and done, right? Even though before they had talked about 125 basis points of rate cuts.
Okay. Made enough pretzels around this table.
Well, I mean, come
just
on, that's kind of what we're dealing with.
as well, the both of us.
Sorry.
Equity futures right now, the S&P 500, negative by 0.2%. Coming up this hour, Emily Rowland of John Hancock as Buy America makes a comeback. We'll catch up with Tom Forte of Maxim Group on the surge in big tech, and David Kelly of JP Morgan reacting to the latest read on inflation. We begin this hour with stocks edging lower following a major relief rally. Emily Rowland of John Hancock writing, for markets, it was all a bad dream. But the prime momentum winners of the trade war, most notably Europe, may not be getting that same continuous bid. Emily joins us now for more. So, Emily, are we saying the winners of the war might be the losers of the truce?
Well, we've just seen this incredible momentum out of Europe, European financials in particular, wearing the crown of momentum, up about 33% year to date, as we saw this sort of sell everything America. U.S. exceptionalism was over. And where do you put those assets? Over in Europe. So I think that trade could potentially take a break here as you see this sort of cautious optimism opening up as it relates to U.S. assets here. Frankly, the fundamentals and the macro backdrop would suggest leaning further into the U.S. over Europe here.
Emily, can we deal with the cautious piece of the cautious optimism? What is there still to remain to negotiate, to reconcile, to resolve that keeps you cautious?
Well, there's certainly some uncertainty still around how tariffs play out. But, John, the problem is you wake up this morning and it's like, again, it was all a dream. The S&P 500 is trading at 21 times forward earnings. We started the year at 22. We've got a little bit to go to get to all-time expensive levels on the S&P 500, but we're there. High-yield bond spreads this morning at 305. That's just about 50 basis points away from historical tights. Markets now are flat for the year if you look at the S&P 500. So there's really not a ton of value, and we're back to stocks being expensive here, especially some of those momentum winners.
So if you are feeling cautious, Emily, what's the caution trade, given that there are a lot of question marks around some of the basics, as you just heard us try to make sense of and maybe make more of a confusion, but there isn't this sense you can just hide out in the dollar and hide out in treasuries in the same way as in the past?
Yeah, I mean, we look at bonds as still being attractive here, 480 on the aggregate bond index. You know, bonds have cheapened up here a bit as we saw that backup playing out yesterday. I thought it was pretty notable to see Treasury yields backing up yesterday. It kind of was a signal that maybe inflation wasn't really the key issue, concerns about inflation as it relates to tariffs, but it was more of the growth scare that was impacting the Treasury market. So you're seeing yields back up. We would look at that here as a gift. We would also think about trimming areas that have run a ton. We talked about European financials, the fundamentals and the macro backdrop not really supporting that as earnings are coming in about -4% year to date in that space. You look at mid-cap growth stocks. That's been another relative winner. The best performing areas of the U.S. market this year have been U.S. large cap value and mid-cap growth. There's a couple of names in there. The biggest name in the mid-cap growth index sports a trailing PE ratio of 500 times. Another big name in the index takes on leverage in order to buy Bitcoin. So those names are up 40-50% year to date. We would look to trim into some strength there. When you wake up in the morning and Bitcoin's at a new all-time high, that is a sign that markets aren't necessarily focused on fundamentals. And it's notable to see how things have shifted. In the beginning of April, it was great not to have a lot of risk in portfolios. And it feels like now you can't even have enough risk in portfolios here in order to participate. So we want to be mindful of that as momentum continues to rally.
There's a lot to unpack there, including how Bitcoin is on your dashboard as sort of a sell indicator. Emily, you did say that it was a gift to buy long bonds at these types of rates. And I want to just dive into that a little bit more at a time when people are really debating how much the current budget could potentially influence yields, how much longer term inflationary impacts from tariffs that are still higher than where they were at the end of last year could also push that yield higher.
Yeah, so it's all about inflation here in our view. And what you saw, there's a few dynamics playing out here. One is that, remember, companies pulled forward a lot of demand. We saw it in the GDP data. We've seen it in the PMI data. The companies overstocked. They have a ton of inventory. At the same time, where there are some cracks in the U.S. consumer, we've talked ad nauseum about the sentiment data. Consumers are worried about their jobs. They're worried about spending. So I think it's going to be difficult for companies to raise prices at a time where the consumer is not necessarily in the best shape. The other element here is housing. Housing is inflation. So we continue to watch that shelter component closely. Last month, the BLS reported that shelter inflation was at 4%, but there's a pretty long lag with the real-time data. If you look at Zillow home price data, it's up about 1.4% on a year-over-year basis. So we think that the official data starts to catch up with that. There's significant issues with housing demand, again, around consumers pulling back. Unaffordability is an issue. Insurance costs are elevated, and we're seeing really big jumps in housing supply at the same time. So we think if housing inflation can come down along with commodity prices, you have a disinflationary story playing out. And frankly, Lisa, bonds are not sniffing that out yet.
Emily, consumer discretionary, with that in mind, rallied yesterday by more than 5%. What do you want to do with that now? How do you want to manage your exposure to that group of stocks?
Yeah, so consumer discretionary would be a neutral for us. I think there's some names in there with pretty decent earnings growth prospects, but again, it's more cyclical. And you've seen, in addition to that, industrials are now the best performing sector in the S&P 500. So you've completely shifted away from this more defensive tone permeating markets back towards cyclicality. We would take a middle of the road approach where you're looking for quality stocks that are trading at a reasonable price, companies with great balance sheets, lots of cash. That had been the baby that was thrown out with the bathwater. We're starting to see quality pick back up here, but we still think that that's the name of the game as we contend with the remainder of this year.
Emily, is it fair to say you're somewhat defensive right now? You seem almost cautious, talking up the prospect for bonds and moving away from the high flyers from yesterday's session.
Yeah, I mean, that's the way, frankly, we came into this year. And it was really not necessarily anything to do with the geopolitical backdrop. It was just the fact that we saw 25% back-to-back returns on the S&P 500 in 2023 and 2024, and that valuations were elevated. We were a bit cautious because of that. It's still, constructive. We still want to own risk assets in portfolios, but to expect another kind of period of really strong multiple expansion, we think was overreaching. We look at 10% earnings growth being baked in for 2025. That's probably a little bit optimistic here. We're still overweight U.S. stocks. We still like U.S. large cap stocks here, just a tad bit more cautious. We like areas like infrastructure. It's the stuff that people need versus the stuff that they want. And then we are finding some value here still on the fixed income space. I know overweight bonds versus stocks has been kind of the widow maker, but we still think that stocks are priced for perfection while bonds are likely mispriced here.
Emily, appreciate the input. As always, Emily Ronan there of John Hancock, making the case for fixed income and bonds over equities.
And it's a cautious case. It's talking about the potential for some sort of rolling over in economic growth, but also disinflation coming from housing prices. You know what occurred to me as I hear everyone kind of making pretzels and discussing these small little points that might hold value? Macro trading is dead. It feels like right now, if macro trading hinges on headlines, and so people are looking for things that are not correlated to these sort of headline risks in the same kind of ways. So they're looking for these small little pockets and kind of adjusting and tweaking and, you know, tinkering.
It's been a great month. You know, I had fun. Been phenomenal over the last few weeks.
I mean, okay, but if you put money at risk and you said, okay,
Super
now I have a framework.
Times. Love it.
Okay.
Whipsawed from one headline to the next. Everyone at home's enjoyed
You
every
seem-
second of
You
this.
seem incredibly excited and happy after the past month.
My head's still spinning. I don't know about yours.
Mine too.
Equity futures on the S&P recovering somewhat, down by just 0.1% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. House Republicans unveiled details of their long-awaited tax package. The draft bill includes many of President Trump's campaign pledges, including no taxes on tips and overtime pay. It also makes permanent the lower individual tax rates Trump signed back in 2017. It does not, however, include a tax hike on the wealthiest Americans. The Trump administration is preparing to announce a deal to grant Saudi Arabia more access to advanced semiconductors, allowing the country to increase its data center capacity. Sources telling our own Anne Marie Horder the agreement would boost the country's ability to buy chips from NVIDIA and AMD. The deal could be announced as soon as this week. And Coinbase, the largest U.S. cryptocurrency exchange, will be added to the S&P 500 next week, the latest milestone for the digital asset industry. Coinbase shares have climbed 260% in the past 2 years, valuing it at roughly $53 billion. The company will replace Discover Financial Services in the index prior to the start of trading on May 19th. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next, the morning calls, plus Tom Forte of Maxim Group as big tech enters a bull market. In just a moment, we'll talk about tech names. Then later, 8:30 Eastern Time, US CPI, just around the corner. Live from New York City, this is Bloomberg.
Going to be the consequence for U.S. markets. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
One hour, 14 minutes away from the opening bell with equity futures slightly negative. We're down about 0.1% on the S&P 500. On the Nasdaq, just turning positive by 0.04%. CPI data 14 minutes away. Let's get you some morning calls. First up, Morgan Stanley cutting its price target on Airbnb to 125, pointing to weak guidance due to soft travel demand. Your second call from Raymond James, initiating coverage of Supermicro with an outperform, calling it a market leader in AI-optimized infrastructure. That name is up by 1.3%. And finally, D.A. Davidson reiterating its neutral rating on Alphabet, saying a complete breakup of the company would unlock value. That stock is negative by 0.2%. Let's keep it on tech. Apple considering raising iPhone prices. The Wall Street Journal reporting Apple may hike prices of its new lineup this fall to avoid the perception the hikes are tied to U.S. tariffs. Tom Forte of Maxim writing, we believe Apple will mitigate tariffs by working with its suppliers, bearing some of the costs itself, and raising prices for consumers. Tom joins us now for more. Tom, good morning, sir. It's good to get you back on the program. What gives you the impression that people would be willing to pay more for an iPhone?
Yeah, so Jonathan, when you think about Apple raising prices on the iPhone, they have a lot of levers they can pull. They can make the Pro model more expensive. They can make the models that have more memory more expensive. So it doesn't necessarily mean an across-the-board raise. But I do think Apple has pricing power, and I think some of that pricing power comes from the fact that you're seeing some very heavy subsidies from the carriers who are competing against each other. So I think that they're not just raising prices for consumers, but potentially raising prices for carriers.
So, Tom, that upgrade cycle that a lot of people talked about over the last several years, that has somewhat remained elusive, Tom. I just wonder how much of a headwind higher prices would be.
I'm thinking about the term elusive, but yes. So the upgrade cycle that never was. So I do think, again, the ability to raise price comes from Apple's status as a premium brand, the strong demand for the iPhone, irrespective of the upgrade cycle, and then also from the benefit of the carriers heavily subsidizing for competitive reasons.
At this point going forward, Tom, how much is Apple in a unique position of hurt when it comes to the tech sector, both by their footprint in China as well as their consumer-facing product that is competing with a host of different other counterparts that have adapted to AI more quickly?
Yes. So clearly, Lisa, what you've seen is that the good news is that the tariff outlook is much better than it was before, but the competitive set in China hasn't changed. And I think when you compare Apple with the other mega caps, Microsoft, Google, and Amazon have the benefit of large enterprise sales from their cloud computing efforts. And Apple is, heavily dependent on the consumer, and as you pointed out, has a much more competitive environment, including in China. You did see a material improvement in sales to China consumers in the March quarter versus the December quarter, but it was still down on a year-over-year basis.
Which brings us to today, Tom. We saw this knee-jerk reaction yesterday in big tech, responding massively to the upside in response to a ratcheting down of tensions between the U.S. and China, bringing tariffs from 145% on China from the U.S. side down to 30%. And there's a real question over who benefits the most. Do you think that the consumer-facing ones benefit the most, Apple, Amazon, or do you think that ultimately it is really going to hinge on what happens with chips, on what happens with the economy, and that, frankly, it's sort of a case-by-case type of story?
Yeah, so in an either-or scenario, I think the companies that are dependent on enterprise spend. So what did we learn in the March quarter earnings? The big cap tech companies are going to continue to spend to ramp their AI-related efforts. So I'd say right now, those companies that are dependent on that spend are better positioned than those dependent on the consumer because I think the consumer's got a bit of whiplash right now, and I think there still is some hangover anxiety, tariff-related, and that could, result in softer economic news.
Hey, Tom, thanks for jumping on. Tom Forder there of Maxim Group, the latest there with Apple, potentially putting up prices. And as you pointed out, I think it's important, not all companies are in the same position as that one company, which is widely considered in tech to be somewhat of a luxury item.
There is this feeling that if people are willing to spend $1,200 on a phone, they might be willing to spend $1,300 on a phone, and it isn't going to be as big of a deal as going to the grocery store and paying $8 for eggs rather than $5 for eggs. There is this question going forward, though, about the 1-2 punch that they get maybe from a lack of sales in China, about the potential ability or not to push suppliers to eat some of the costs, and just how much of an advantage they have in the super cycle given some of the technological advancements happening elsewhere in the smartphone industry.
Not everybody's Tim Cook or Apple for that matter. CPI drops in about 9 minutes' time. Joining us now, jumping on, Mike McKee. Mike McKee with a preview. Morning, Mike. Tell us what we can expect in a few minutes' time.
Well, we're not, John, expecting a huge change in CPI, an increase in the headline and an increase in the core of 0.3%, but that won't change the year-over-year numbers, 2.4% headline and 2.8% for the core. The real question is, where do we see, or do we see even, some tariff-related increases? You can look at furniture, you can look at electronics, things we get from Asia. Automobiles, did new car prices go up because everybody was trying to buy them, or used car prices because there was a shortage of new cars? So a lot in there to watch for. I thought the most interesting comment today came from the folks at Morning Money over at Politico, who said the Trump administration is the not yet administration. Prices are going to go up, but not yet. The economy is going to slow, but not yet. We're sort of at the end of the not yets. We might start to see some of this start to happen.
Mike, you've seen all the updates coming from Wall Street, the new calls for the first Fed cut, all pushed back. We heard it from Barclays, from Citi, from JP Morgan, from Goldman Sachs. Mike, what do you make of the Fed debate following the truce between US and China over the weekend?
I think the Fed doesn't change its mind at all because, first of all, we still have tariffs of 30% on China and a 10% universal tariff around the world. And this is Donald Trump. He could change his mind again any time. So the Fed is still on hold and going to stay on hold for a while.
To that point, Mike, yesterday we heard from Chicago Fed President Austin Goolsbee in the New York Times saying it is definitely less impactful and stagflationary than it would have been. However, it's 3 to 5 times higher than what it was before. He's talking about the tariff rates. So it is going to have a stagflationary impulse in the economy. Fed Governor Adriana Kugler having a similar type of tone. Mike, is your sense that most of the members from the Fed speak that we have heard and the Fed speak that you are going to engage with, that they're really emphasizing the stagflationary kind of bent to the data and the fact that inflation is going to take probably the bigger emphasis in the near term?
Well, it probably will in the near term unless we have some sort of dramatic slowdown. The odds of that seem to have backed off a little bit. But if you get the kind of inflation they're anticipating, you will have a bump up. The question is, how long does that last? The idea is that tariffs are a one-time increase in the price level, and the Fed can look through that. But if this is going to be an ongoing cycle of tariffs on, tariffs off, then they have a longer-term stagflation problem they have to deal with.
Mike McKee with the latest. Mike, stay close. Mike will break the data in about 6 minutes' time. CPI is just around the corner. The estimate in our survey for headline CPI month over month is 0.3%, stripping out food and energy core month over month. Looking for that to come in at 0.3% for the month of April. The previous month, that reading was 0.1%. You mentioned the governor, Adriana Kugler. The tariffs appear likely to generate significant economic effects, even if tariffs stay close to the currently announced levels. They are staying the course, aren't they? Steady hand.
At this point, if they flipped as frequently as some of the policy proposals did, they would be accused of reacting quickly at a time when policy is uncertain and it takes a long time to get to the economy. If they don't give some sort of guide, then there's a question of what forward policy and the sort of tool that they have, given that communication has been so instrumental for them, about what kind of value that has if they're just saying wait and see over and over again. So they're between a rock and a hard place. Key question that I have is, how quickly will some of the effects, the significant economic effects, as Adriana Kugler said, make their way into data that people can rely on? And that's going to be increasingly difficult to tell.
The good news for the Federal Reserve is they only have to put out a forecast every quarter. That's the good news for them. A lot of people on Wall Street do not have that luxury, which is why we see them marking to market or marking to trade negotiations every single week.
This morning I came in and I saw these notes piling up and I thought, here come the revisions. And it's revised in every single different way. You have some people upgrading their revisions for end of year S&P 500, some people upgrading their expectation for growth, downgrading inflation, other people upgrading their inflation forecasts, other people talking about how maybe they should sell here because all the good news has been priced in. So everyone's revising, trying to get a handle on something that we're not going to get clarity on in 5 minutes' time, but we're going to try.
Jonathan Pingler, UBS, said the change in tariffs could imply around 0.4 percentage point additional GDP growth this year and potentially a little boost to next year, too, of 0.2. So that's the direction of travel. Up next, CPI data and reaction from Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Seconds away from inflation data in the United States, with equity futures almost totally unchanged on the S&P 500, on the Nasdaq positive by 0.1%, adding just a little bit of weight to the big rally in yesterday's session. The scores in the bond market look like this: the 2-year, 10-year, and 30-year firmer with yields lower. We're down by 3 basis points on a 2-year. We're down by 2 on a 10-year to 4, 4.44. With your inflation data this morning, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. A little bit of a surprise here with a little bit less inflation than anticipated. The headline comes in down, up just 0.2%. The forecast was for a 0.3 gain. Same story with core, up 0.2 after a 0.3 forecast. On a year-over-year basis, that pushes the headline down to 2.3%, and the core stays at 2.8%, which is what had been anticipated. The index for shelter up 0.3%. That was more than half of the all items monthly increase. Energy also increased, up 0.7%. Gasoline index did decline. Food fell 0.1%. Food at home decreasing 0.4%. That's groceries, basically. I'll look into the rest of this, and we'll look for some tariff implications, John, while you check the markets.
Yeah, I'll come back to you in a second, Mike. So unlock some gains in the equity markets, like downside surprise on CPI. Equity futures now firmer by 0.2% on the S&P. Going into the print, totally unchanged on the NASDAQ. We're up by 1/3 now. If you turn to the bond market, 2-year, 10-year, and 30-year, seeing yields fall, down 5 basis points on a 2-year, down 4 on a 10-year. So the yield on a 10-year maturity is 4.4256. You know the rules coming into this. The rules were as follows. If the number was bad, ignore it. If it's good, it's really good.
Well, right now, on the margins, you could say that disinflation in a couple of industries could potentially give the Fed a pass to cut rates sooner, even if the pain isn't as great. This has been the argument that Peter Scheer made, that you could actually see 3 or 4 cuts still, even without that downside of recession. And that seems to be what this market maybe is sniffing out peripherally from this data that doesn't really matter, but maybe people will think absolutely does, and that's what they're trading on.
How long is it going to take to get a clear read, a clean read on the U.S. economy?
It's a great question. I don't know the answer to it, and I think nobody does. And that's the reason why they're looking under the hood, just like Michael McKee, to try to understand the details, to see if there's some more insight coming from that.
Mike, have you got a second look for us? What do you see?
We got a second look for you here, and I'd say this fits with the theme that the Politico people had out this morning of not yet. Most of the categories you would expect to rise if tariffs were in place are not up much this month. The gasoline prices were down 0.1%. That's always something that drives this stuff. But if you look at household furnishings and supplies, they were up just 0.2%. And when you look at apparel, it was down by 0.2%. The expectation was it might rise some. New cars up just 0.1%. Used cars down 0.5%. So the big increase we saw in wholesale prices hasn't hit yet. Then you go on and take a look at things like toys. Toys were up 0.3% after falling 0.9 last month. Let's see if that's any kind of a harbinger going forward. We mentioned rent of shelter and owner's equivalent rent. They were not a major contributor this time, or rather they were more, I'm sorry, 0.4% for owner's equivalent rent. And then the motor vehicle insurance, which has moved up a lot, up 0.6 again. Video and audio services down 0.6. There was a thought that might be something that would rise because of tariffs. And airfares were down on the month. That was also something that people were watching to see what we would get in terms of people not wanting to come to visit the United States. But right now, we are seeing a decline there. Airline fares off by 2.8%, and that helped keep inflation down, even though it may reflect tariffs and the general feeling about the United States.
Mike, thanks for the breakdown. We'll come back to you in a few minutes' time. Mike McKee there with CPI. So the shorter version of all of that is that we got a downside surprise on CPI, 0.2% against an estimate of 0.3, both on headline and on core, month over month, and that unlocks some gains in the equity market, just briefly up by a few 0.1% on the S&P 500. That's the equity story. In the bond market, unlocking some lower yields. On a 2-year, down by 3 basis points. On a 10-year, we're down by about 2 or 3 basis points as well. The 10-year, 4.45. Joining us now to discuss, Tiffany Wilding of PIMCO. Tiffany, welcome to the program. We were told to ignore some of the data throughout this morning. Can we ignore this data?
Well, yeah, I mean, I think there is a lot. It sounds like there's a lot going on under the hood. But the overall message is that, the U.S. economy prior to any sort of tariff pass-through was just on a continued path towards normalization after the pandemic-related shocks. Inflation was elevated. It's remained elevated. And I think overall this report, suggests that some of that is coming down. And if it weren't for tariffs, the outlook would be towards more moderation. But I do think you have to discount this a little bit because we know eventually the tariff costs, which are major, will be passed through to some extent. Now maybe one more point on that is I think the interesting thing is that we're hearing from some of these larger retailers, as they are trying to hold the line on prices, it seems like as long as they can to increase market share. They had the ability to front run this by importing a lot of inventory ahead of time, so they might have a bit more of a window before they really need to raise prices.
That said, Tiffany, if you look at some of the details under the hood, there is this question about whether some of the components that contributed to the smallest increase since February of 2021 are sticky, are durable. And I'm thinking of housing, which we were talking about with Emily Rowland earlier, as well as the gasoline prices. How much is that going to be a disinflationary force that will be thematic through the rest of this year?
Yeah, well, certainly we've seen a fall in gasoline prices. I think the interesting thing is if you look at U.S. Gasoline and other U.S. energy prices, they have not fallen as much as global oil. So I think it'll be maybe a little bit less disinflationary, than if you're just looking at oil prices. But you will get some benefit from that. I think on the housing side, I think there's real questions here. The tariffs clearly will raise housing costs. The things that we import in terms of appliances, and other inputs into to building homes, most of that comes from China, and so that will cost more. And eventually that will filter through into higher rental prices. Now I think near term against that. We found evidence that the increased flow of migrants into the United States, did raise rentals in sort of the lower, smaller rental apartments and things like that. And we think that's why you saw OER, moderate, come down, inflation come down there much slower than many people were expecting, is because you had this offsetting inflow. Now, obviously, that force is waning and potentially even reversing, so that could result in some faster deceleration near term in some rental costs. But I think ultimately the longer term outlook there is for stickier housing costs as a result of some of these tariffs.
John pointed out that we're all kind of tying ourselves in pretzels as we try to get all these counter forces together, whether it's the immigration story, whether it's the tariff story, whether it's what the economy was heading into all of this. He also asked me, and I had no answer about when the data would be clean, when we would get actually something that we could rely on. So I will ask you, at what point do you think that you can see sort of the new normal in the data, or is that not really going to come back? Are we going to have to watch these trends sort of in parallel fashion and try to compile a picture?
Well, I think that the new normal is, I think we're quite a ways away from that. I think the bottom line here is just that taking a step back from the headlines and things like that, the average effective tariff rate that we calculate as a result of these trade policies has increased more than any time in a century. That is a dramatic economic shock. And it will take time for that to flow through the system, and we aren't going to see the quote unquote new normal on the back of that. We think for quite some time. When I say quite some time, maybe a year or more for the economy really to adjust, assuming these tariffs stay in place. So, I guess to settle in and let's see what happens.
Do you think you have a best guess right now? Any kind of guess, any kind of take whatsoever on the nature of that shock, Tiffany? I get that it's a policy shock, but is it a inflationary shock, a disinflationary shock, a growth shock, a negative supply shock? What kind of shock is it?
Well, I think it acts like all of those that you mentioned, and I think the bottom line is because we haven't seen the type of policy like this in quite some time. We don't exactly know how it's going to filter through into the economy. Again, we have a best guess about that, which is that we think you will get some price level adjustment that occurs. because firms have to pass on the additional costs of tariffs, and they will do so eventually, that will result in a real income squeeze because you don't see wages adjust as quickly. We ultimately think over time wages could adjust, but during that real income squeeze, that just means that real consumption, is hit by that. And there's some knock-on and second-round effects from that. As volumes start to decline, because prices are higher, then that just means you potentially need to hire less people. You'll probably get some margin squeeze. It could be detrimental to investment trends in the United States. I think the magnitude of these things and how they play out over what time frame, I guess is really the question here. And then how inflation expectations adapt to all of this. I think the real concern from the Federal Reserve, for example, is that we've come off of a period of elevated inflation, and having another shock that should be a one-off sort of temporary thing can result in inflation expectations drifting higher, can start to creep into wage negotiations, and can result in more persistent inflation. I think that's what the Fed is concerned about.
Tiffany, appreciate your take as always. Tiffany Welding there of PIMCO. Speaking of inflation expectations, you, Mitch, inflation expectations, and update another read on that on Friday. If you are just joining us, welcome to the program. Moments ago, CPI, small downside surprise, year over year, 2.8%, the smallest increase since February 2021. Mike McKee, how much comfort can we take from the smallest increase since 2021?
I don't think economists will take a whole lot of comfort for the same reasons that Tiffany was talking about, the fact that we don't know yet where all this is going to show up, but we do expect something to show up. It'll be interesting on Friday to see how this CPI report and the news of what's gone on with China plays into that University of Michigan number, because people have been very depressed about the outlook. Do they feel better, and then do they bring down their inflation expectations? I do want to mention two bits of inflation numbers that the president has harped on. One is energy. He said it's come down. It didn't. It went up 0.7. He should have mentioned gasoline, because gasoline is what was down 0.1%. Natural gas up 3.7% on the month. So energy's still up. However, food prices, as he suggested, had gone down during the month by 0.4, and eggs down 12.7%. So the president gets a win there. Yeah.
The poster child of the inflation story of the last few months. Mike, thank you. Eggs are down. I think it's fair to say that when the president's talking about energy, he's talking almost exclusively about gasoline.
That is what's going to make an impact on people who go to the pump, which is a reason why he cited something below $2 a barrel that people have been looking for. But there is this question of how much that will actually give a tailwind to the real incomes of a lot of people, and how much that's actually going to bring headline inflation pretty much where it is, or a little bit lower.
The confidence story, the psychological impact of seeing that framing, it's really, really important. David Kelly of JP Morgan Asset Management joins us now to build on some of this. David, welcome to the program, sir. What's your initial reaction to these numbers this morning? How useful are they?
Well, usually when we're on this call on CPI day, it's like the biggest news of the week. But today obviously it's the tariff news. But also I think the other big part of the inflation story going forward is the fiscal stimulus that's beginning to emerge on Capitol Hill. Because what it looks like is, okay, the tariffs aren't here, and consumers are relatively quiescent right now. I mean, we're not seeing a lot of enthusiasm there with the airline fares and so forth down. But it looks like they're cooking into this bill stimulus for 25, 26, 27, and 28. They're implementing a lot of the president's promises on the campaign trail, in addition to extending the tax cuts. And if that comes through, you're going to have a surge in consumer spending in 2026, helped by fiscal stimulus, and perhaps even later in 2025. That'll keep inflation a little higher. So this is good news in inflation, but I think the signs are that inflation is going to move up in the short run because of tariffs, and then in 2026 because of renewed fiscal stimulus.
David, is that a reason to be bullish the equity market?
Probably not. The equity market is hard. I don't know exactly where we are right now, but it's hardly down year to date. And we've done a sort of round trip on tariffs here, but we still end up with a higher tariff rate than we had at the start. I think we've got slower long-term economic growth. So in some ways, the relief rally has been stronger than the downturn, and I think it may be a little bit overdone. So I'd still caution people, longer term, the huge premium that U.S. equity prices have over the rest of the world probably isn't justified. And so I'd still be in the diversification camp here. I do think there's, a 10-year Treasury yield at 4.50 to 5 is probably more reasonable than a big fall from here. But I think it's too early to be really bullish about equities because of fiscal stimulus, because we're talking about a full employment economy where the Fed's going to have less reason to cut.
We've been struggling all morning with whether this really is the beginning of the return to the United States and the dialing back of some of the loss of U.S. exceptionalism types of narratives, or whether this is just a pause in the go international trade. David, you talk about diversifying. What does that mean if you think that the 10-year yields are going to be in a 4.50 to 5 range and you don't really find U.S. equities particularly attractive right now?
Well, it does mean international equities. I mean, yes, the U.S. equity market has almost done a round trip year to date, but European equities up very strongly. International equities in general are up strongly for the year, and the dollar is down. I think that will continue because, we will still end up with significant tariffs at the end of all of this, even though we're seeing, it's calming down. We're going to end up with higher deficits. We're going to end up with lower immigration, probably lower economic growth. So I know, this is a package, an agenda that the public has voted for, and that's why we have elections. But it does suggest a slower trajectory in U.S. economic growth with higher deficits, somewhat higher inflation in the short to medium term. None of that is really very pro-U.S. And the thing is, I think the U.S. will do okay. But does it deserve to be, at 50% premium over the rest of the world in terms of PE ratio? So I'd say international equities, yes, and then also alternatives. If fixed income is not going to help you because of higher inflation, alternatives, there are plenty of alternatives, things like infrastructure, transportation, real estate, which have a degree of inflation protection. So I think people just need to broaden their definition of diversification in this kind of environment.
You mentioned the Fed's response, and this has been a subject of a pretty heated debate. And frankly, it feels like people are bifurcated on just whether this gives the Fed more incentive to cut rates just for the good reasons or less incentive. From your perspective, is this more of a reduction in potential inflation in terms of the lower tariff rate than it could have been that gives the Fed more of an ability to cut rates without a recession at a time where the data that we just saw, albeit messy, does point to something of a much lower pace of price increases?
Well, yes, but the Fed's target is 2. And I think on the consumption deflation, I think Jay Powell put it pretty well at his latest press conference. They're going to have to look at where they think inflation's going and where they think unemployment is going. And I think the both fiscal stimulus that is beginning to emerge from Capitol Hill and then also somewhat lower tariffs, they suggest that the risk of recession is receding here. I think you've probably just gone below 50%. So risk of recession receding, maybe the unemployment rate ends the year 4.5% to 5%, but the CPI the consumption inflation could easily end the year above 3%. In fact, it probably will. So we're probably going to be further from the consumption deflation target than from the unemployment target. In that kind of environment, there's not much excuse for the Fed to cut at all, because we're at fairly close to a neutral level. So I think the Fed will take it very easy here, and it's part of the story is tariffs, but the other part is putting more fiscal stimulus and higher deficits into 2026 really doesn't give the Federal Reserve a reason to be easy.
Is your base case no cuts now, David?
No, not quite. I think we will get at least one cut this year by the end of the year. I think the Fed realizes they can edge rates down a little bit, but I don't expect a cut in June. I don't expect a cut in July, to be honest. I think they'll want to see much more of much more certainty around what the tariff picture really is and how much stimulus is in this bill before they contemplate any cut. So I think we're going to have to wait some time for the first rate cut.
Interesting. David Kelly there of JP Morgan. David, good to see you, sir, as always. My takeaway from that conversation is how the attention has shifted very quickly from trade to taxes.
And this might not be a picture that is as simple for the bond market. The idea of who is the bigger potential pushback from some of the proposals. Is it going to be other Republicans or is it going to be the bond market? And a lot of people, and that was Peter Scher's words, I'm copying them, but a lot of people are waiting for that ramification.
I think they were my words, actually, Bramo, not Pete's.
I apologize. Okay, please, they're Jonathan Ferr's words. They're fantastic words.
Let's put that on the record. Very special, important words Two-year yields are down by a few basis points this morning, down 4 on a 2-year. On a 10-year, we're down by about 2 basis points to 445. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. We start by recapping the latest economic data. U.S. consumer prices rose less than forecast in April. Core CPI rose 0.2% from March, lower than the expected rise of 0.3%. The data suggests inflationary pressures are limited, but remain at risk of building as companies look to pass on the cost of higher tariffs. Meanwhile, the U.S. is projected to lose $12.5 billion in travel revenue this year. The World Travel and Tourism Council telling Bloomberg visitor spending is estimated to fall 7% versus a year ago. The decline in tourism is attributed to a strong dollar, some lingering COVID-era travel requirements, and a negative view on President Trump's America First rhetoric. And Apple wants you to be able to control your device with your thoughts. According to the Wall Street Journal, the company is taking early steps to allow people to interact with their iPhones with neural signals captured by brain implants. Apple has worked with Synchron, which makes a stent-like device implanted in the brain's motor cortex and is able to read brain signals. That's your Bloomberg brief. John?
Nope. Yahara, thank you. Appreciate it.
I knew you were going to say that.
Honestly, some of the technology out there these days. This could be used in really great ways, by the way. And we talked about it with regards to Elon Musk, people with disabilities. This could be absolutely fantastic. For everyone else, this is just going too far, isn't it?
Sure. If you've had a stroke and you want to be able to communicate in a way that you can, fantastic. We highly support. There's this question about if they don't have our brains enough in the scroll features and the suggested headline features, they need to actually take control of our brains. I mean, what more can we possibly do with this thing?
Manipulate it and all of that stuff. No, want nothing to do with that. And then sell you ads. And okay. Up next, we'll set you up for the day ahead from New York City. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil.
The opening bout just around the corner, 35 minutes away. Equity futures on the S&P just about positive. Your day and week ahead look like this. Later on today, President Trump, of course, in Riyadh for the first stop of his Middle East trip. Look for headlines that come from that. Tomorrow, the president heads to Doha. Thursday, we'll get Walmart earnings, PPI, retail sales, and another round of claims, plus remarks from Fed Chair Jay Powell. And President Trump heads to Abu Dhabi. And on Friday, we get another read on UMich consumer sentiment. Just to wrap up this morning, small downside surprise on CPI, but attention started to shift to the tax bill down in Washington, D.C. The bond market maybe just starting to pick up on some of this.
A real question here about which is going to take precedence at a time where a lot of the data is becomes so messy that it's to be rendered useless. So how much do people have to look to forward-looking policy and what actually does get done in Washington, D.C.?
That conversation will continue tomorrow morning. Coming up tomorrow, Victoria Fernandez of Crossmark, Wei Lee of BlackRock, Kate Moore of Citi, and Lindsay Rosner of Goldman Sachs. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Italian Open update for Bloomberg TV and radio from Tennis Channel. So far, so good for Jannik Sinner. The world #1 has played 4 sets and won them all on his return to the ATP Tour. Monday, the Italian delighted the home fans as he dispatched Jesper de Jong, extending his current win streak to 23 matches. And don't forget, you can watch all the action live daily on Tennis Channel.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read.
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
All right, we got another little rally on our hands. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
A positive surprise on CPI. U.S. inflation comes in lighter than forecast for the third straight month. That data giving stocks a little bit of a boost this morning. And Goldman Sachs lifts its S&P 500 target, but remains cautious due to lingering uncertainty. Plus, we are live in Riyadh as the focus of President Trump's deal-making shifts to the Middle East. Katie, what stocks are you watching?
I have my eyes trained on United Health. It's plunging right now, down 10%. That's after it suspended its outlook for the year. The insurer is also naming board chairman Stephen Hemsley as its new CEO, replacing Andrew Whitty. Matt, this is another boomerang CEO.
Yeah, very interesting story. We're going to dig deeper into that. We're also watching Coinbase jumping after S&P announced that the crypto exchange will replace Discover Financial in the S&P 500. So, Katie, a real changing of the guard.
Let's get back to one of the big stories this morning, and that is CPI coming in cooler across the board, despite fears that inflation is headed higher amid the trade war. Now, before the data was released, Citadel founder Ken Griffin spoke to Sonali Basak about inflation in an episode of the upcoming series Bullish.
One of the reasons that Trump won the election was the American people had had enough inflation. They wanted a break from seeing their standard of living deteriorated by the ever-increasing price of goods and services. And so I really do think that the president needs to think long and hard about the necessity of helping to protect the standard of living of the American people by keeping the inflation, like, it's not a genie, it's like the inflation devil in the bottle.
Now, again, that was recorded before we got this morning's CPI report. So let's break it down now with Bloomberg's Mike McKee, who covers policy and economics for us. And Mike McKee, we didn't see much evidence of the inflation devil in this report, even though many expected us to.
Yeah, this is the not yet administration. Trump tariffs are supposed to cause a slowdown in growth, but not yet. They're supposed to increase inflation, but apparently not yet. CPI comes in lower than expected on a headline basis, up 0.2% for a 2.3% annual rate, which is the lowest since 2021, getting very close to the Fed's 2% target. The core also up 0.2%. Base effects keep that one at 2.8% on a year-over-year basis. But as Katie's talking about, under the hood, are there any signs of tariff push inflation? Not really. Household furnishings come from Southeast Asia, 0.2%, not much of a gain. Apparel costs down 0.2%. The wholesale rise we saw in used cars doesn't translate into consumer prices down 0.5%. Video and audio products, they were up 1%. Maybe that's the only canary we can find here. Airline fares, now this is an interesting one, down 2.8%, but this is because of tariffs and everything that's going on. Nobody wants to come to the United States. So apparently airline fares are down. And of course, the big number of the morning that the president is going to be touting, this is probably going to even be bigger than any kind of business deal he swings in Saudi Arabia. Egg prices down 12.7% in the month of April.
All right, Mike McKee, I'm looking forward to seeing that play through into the retail price that I pay at ShopRite. Mike McKee there, our international policy and economics correspondent. President Trump's first day in Saudi Arabia is already making headlines. The administration reaching a deal to grant Saudi more access to advanced semiconductors. This deal allows the government to buy chips from companies like NVIDIA and AMD, despite its ties to China. Bloomberg's Tyler Kendall joins us from Washington with more. Tyler?
Yeah, hey, Matt. Well, as you mentioned, this is still being finalized here, but we could expect the details of this deal to be announced as soon as this week, according to people familiar, as President Trump makes his way through the Middle East. The plan would give Saudi Arabia more access to these advanced semiconductors, but does come amid concerns from the Trump administration that the technology could fall into Beijing's hands. With that said, they are thinking about a few different provisions here that could potentially help to counteract that, including giving the U.S. government control access to data centers that ultimately use these chips. Of course, it comes against this broader backdrop of collaboration between the two countries when it comes to artificial intelligence and advanced technology, which really has been one of those areas where they've seen progress on, considering that the Trump administration has recently moved to rescind the Biden-era AI diffusion rule, which the kingdom had been lobbying them to do. Now, more broadly speaking, we could expect some other deals to come out of this. We know that President Trump is pushing for some pretty heavy investments from the kingdom. I actually was at the FII summit back in February. It was a Saudi-backed investment conference where President Trump first floated that he wanted to see $1 trillion worth of investment out of the kingdom into the U.S. Bloomberg Economics says that's a highly unlikely number to reach, since Saudi Arabia has its own domestic policy goals that could counteract with that. But still, Matt, the kingdom had pledged when President Trump came into office that they would invest $600 billion into the United States over the next 4 years. That's a pretty hefty number. It accounts for about 55% of the country's GDP.
So perhaps we'll see more headlines like that one. But tell us a little bit more about what to expect from this trip. As you mentioned, it definitely seems like investments, securing investments are the goal rather than discussing some of those security issues, perhaps.
Right, exactly. And Saudi Arabia and the region at large has been sort of at the center of a few different policy priorities. You alluded to it there. Of course, the foreign policy front, Saudi Arabia has been key to the administration's push to try to reach an agreement, particularly when it comes to the Russia-Ukraine conflict. But really, we are expecting this to move away from foreign policy and really towards those investment goals, as President Trump takes this tour in the backdrop of his tariff plan, trying to convince Americans, consumers and investors alike, that he's bringing in more investment to help boost his ultimate goal of domestic manufacturing. While President Trump is in Riyadh today, we are expecting him to shortly address the U.S.-Saudi investment conference. That's why we see a lot of big CEOs also there to greet him, including Elon Musk, Sam Altman, and NVIDIA's Jensen Huang.
All right, that is Bloomberg's Tyler Kendall in Washington on the latest on the Trump administration. Let's switch gears now and get back to United Health Group, because shares absolutely plunging in the pre-market this morning. That's after surprising investors twice this morning. The insurance giant pulled its guidance for the year. It also named board chairman Stephen Hemsley back to the helm, replacing former CEO Andrew Whitty, effective immediately. Let's unpack this news now with Bloomberg's Cynthia Coons. She leads our U.S. health coverage. Cynthia, we'll get to the guidance poll. I want to talk about the change at the top, though, because it's interesting to see a boomerang CEO here, one that is 72 years old, really underscores the issues that this company is facing.
Yeah, it really shows some of the control he's had of the board and the influence he wields, that he's stepping back into this position, and that's happening so abruptly. This caught, obviously, the market and investors off guard. It is maybe not surprising that Whitty was starting to run into trouble. The earnings outlook downgrade, which now has all been pulled, was a big disappointment, and they've had some downgrades in the past year and change, which is very unusual for United. They've been kind of a beat and raise, really steady Eddie growing stock for a long time. So the fact that he was in trouble doesn't seem to be a surprise to the market, but the fact that they made such an abrupt and quick switch and bringing the chairman into this permanent position was really surprising, and I think there's still a lot more for us to unpack here as we report this throughout the day.
So what has been, I mean, obviously there was the tragic murder of a unit head that got everyone's attention, but that is not what's driven the drop in the shares over the last month. I mean, they're off 40%, not even considering what we're looking at in the pre-market. What's the problem at United Health?
Yeah, there was a big reaction, obviously, from the public after that murder. It was obviously a tragic event the company had to reckon with. But what's really been pressuring them from a financial point of view has been Medicare. And they've been bringing in a lot of customers in Medicare, and they just haven't been pricing it correctly. And so these customers are needing more care. They're needing more medical treatments and services than the company has basically budgeted for. And so this is a persistent problem. It's not going away. They're trying to explain why that might be happening, but the explanations aren't keeping up. The numbers aren't keeping up. So the fact that they had to pull their guidance is just a glaring indictment of the fact that they couldn't pull that off.
Yeah, and that year-to-date chart really ugly. You saw that big drop in April. That's when they cut their guidance back in April. The shares fell 23% in a single day. So it's definitely been a really rocky couple of months for this company. We appreciate you staying on top of it. That is Cynthia Coons, who heads up U.S. health coverage here at Bloomberg News. Meanwhile, let's take a quick check on these futures. As Matt said, a really little rally in the S&P 500 right now. It was lower pre-market after that big day that we got yesterday. That CPI report helping to lift futures a little bit back into the green, and we'll discuss the details next. This is Open Interest.
The most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
What is the issue between the type of information that's being collected by investors and the marking?
Mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The U.S. CPI report coming in cooler than expected. The news sending futures higher ahead of the opening bell. Let's get reaction from UBS U.S. economist Abigail Watt. So, Abigail, we've kind of gone through some of the numbers here. It's interesting that, for example, Anna Wong from Bloomberg Economics said, this should be the first snapshot of the effect the Trump tariffs from Liberation Day have on inflation, and it came in better than expected. Less inflation that Americans are going to have to face than maybe economists that we surveyed would have thought. Why is that? Why the positive surprise?
Yeah, so as you say, the inflation numbers this morning did come in better than expected. A 22 basis point rise in headline, 24 basis points in core. When we look at kind of the gap between our projections and what we saw in the print today, the bulk of the gap between our forecasts and what was realized was actually on the services side. I think we obviously saw softer kind of transportation services in particular in the print. So I think that was one element in terms of the downside surprise for us. But I think the important thing to note is that when we're looking for the impact of tariffs in the inflation data, we're looking at things like the core non-transportation goods. And when we looked at prices there, those rose 21 basis points. That was less than we had expected, but it's still the third highest rise in that component in the past 2 years. So I do think there are some initial signs potentially of some of the kind of tariff impacts in the data today.
So if you're looking for tariff-related impacts, and to be clear, that's what everyone is doing with these numbers, you can find it when you take a look at specific categories, like you mentioned, core non-transportation there. But when do we potentially start to see that ripple effect, basically to see it in more of these categories? Because it feels like investors are just on high alert for that.
Yeah, so I think there's a number of different reasons to think through the kind of potential lags here in terms of when we would see the tariffs potentially hitting the inflation data. When we look at the experience of, say, 2018, 2019, there tended to be a 2 to 3 month lag between the tariff announcements and then seeing some of the reaction in prices. I think the key thing to note is, there's a difference between kind of the tariffs being applied in terms of a formal announcement and then goods that are in transit. So there's still goods in transit that won't necessarily be covered by the kind of tranches of tariffs that we've seen in recent weeks. I think the other thing to note is that companies often have inventories, so you might not see as quick a pass through into prices with companies choosing to kind of rely on inventories rather than immediately passing on prices. And then I think the other thing to think about is just the kind of goods that are being tariffed. For example, if it's an input price, an input good rather than a kind of final demand good, then it could take a little bit longer for kind of some of that to show through into the inflation data.
I just want to mention that we're looking at President Trump. We've got live shots here of President Trump in Riyadh with Crown Prince Mohammed bin Salman. This is a signing ceremony. We told you at the top of the program about the economic partnership that the U.S. and Saudi Arabia have been discussing. Apparently, they're signing some contracts of that nature. President Trump hates memorandums of understanding, so that's definitely not what they are. But agreements of some sort, and we do expect to hear from the president on a panel with MBS shortly. We're going to bring you that live as soon as we get it. In terms of the kind of inflation that we're seeing here, Abigail, I mentioned Anna Wong from Bloomberg Economics. She said she expects to see a tick up in prices for core goods like cars, and certainly we've already seen a lot of that, and we're going to see more of it from companies like Ford raising prices to deal with tariffs and others. We're going to see, according to Anna, a jump in prices for clothing, for furniture, for household appliances, and housing costs, with the exception of the lowest tier of rents, are expected to go up. How do you see this affecting the American economy? Even if we avoid a recession, isn't that damaging?
Yeah, look, I think obviously our growth forecasts have been marked down relative to kind of a no tariff baseline. We do expect that this will feed into kind of slower growth in the US economy. And I think the key thing to think about is, as we were coming into this year, we were already expecting the US consumer to slow. We thought that the kind of delta that they would get in terms of improvement on inflation would be less than we had seen in kind of recent years. And this is actually going to offset, some of that positive delta that we were expecting to come. I think at the same time, our expectations are that the labor market will also continue to slow, so we have to think about the income side of the equation for consumers as well. I think the other thing to think about is whether whether this leads to interest rates being elevated for slightly longer, and in that environment, how does that feed into kind of household balance sheets as well? If you've got kind of slowing real income growth at the same time as interest rates remaining a little bit higher for longer, it potentially puts a little bit more pressure on household balance sheets.
Well, Abigail, that's exactly where I wanted to go, because in the past 24 hours, it's interesting, you've had economists from all the big banks come out and push back their rate cut forecasts. JP Morgan, Goldman, Citi, all pushing back their forecasts for when the next Fed rate cut actually is. You take a look at this data this morning. How do you think this factors into Fed policy?
Yeah, look, I think if we think about the culmination of the changes that we've had, not just the inflation data today, the kind of news yesterday on the change in tariffs on China, I think that's one reason why the message from the FOMC last week was one of not being able to be preemptive in this environment. Obviously, I think with the changes in policy yesterday, the expectation would be that the inflation impulse from tariffs would be lower than we had previously estimated, clearly with the reduction in terms of tariffs on China. But there is obviously potential for kind of other tariffs to come into play. There's still ongoing Section 232 investigations that we're watching kind of closely to think about the potential for kind of sectoral tariffs as well. And I think it will continue to be something that is a kind of headwind to kind of inflation, to the economy and a contributor to inflation this year. So I think for the FOMC, this idea of the economy seems robust for now and policy is kind of well positioned for where the economy is just now, but then needing to kind of just be kind of reactive rather than preemptive is kind of consistent with our expectations. So we actually have the next cut from the FOMC at the September meeting. So we have them on hold through the summer.
All right, Abigail Watt, thanks so much for joining us. She of UBS and U.S. Economics. Really appreciate your time. Hope we get back soon. I want to get back quickly to Riyadh here because we're looking at more signings, and if Trump signed an economic partnership between the U.S. and Saudi Arabia, the rest of these cabinet members are signing, apparently, memorandums of understanding. So Chris Wright signing one on energy, Pete Hegseth signing an MOU on defense, the U.S. and Saudi Arabia signing a memorandum of understanding on mining and minerals rights. So this looks to be really a longer and drawn-out signing ceremony, Katie, with an announcer, I guess, giving details to the audience of each MOU or framework agreement that's being signed.
Right, and as Tyler Kendall explained to us, we should expect a lot of these sorts of headlines and probably a lot more news when it comes to investments. That is why the Trump administration has traveled to Saudi Arabia. That is the goal here, and looks like we're just getting started.
Look at all the gold. President Trump has got to feel right at home with all of this gold and pomp and circumstance.
The man does like gold.
We're going to continue to cover this, bring you any headlines that cross, and of course, we're going to go back to Riyadh for the Saudi Arabian Economic Forum, where we will watch President Trump speaking with Crown Prince Mohammed bin Salman. The Open in 10 minutes. This is Bloomberg.
الإدارة الوطنية للملاحة الجوية والفضاء ناسا في الولايات المتحدة الأمريكية للتعاون.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Well, Goldman Sachs is lifting its 3-month target on the S&P 500 to 5,900, which is only a gain of less than 1% from current levels. Here's the reasoning, with David Kostin writing, already optimistic market pricing of the economic growth outlook, as well as uncertainty surrounding the magnitude of the impending slowdown in economic and earnings growth, will likely keep a ceiling on equity multiples during the next few months. Let's discuss now with Ron Temple. He is Chief Market Strategist over at Lazard. Ron, it's great to see you in person.
Great to be here. Thank you.
So that's the Goldman view, that maybe we stall out for the next 3 months, but 12 months from now, they see the S&P 500 at 6,500. So the direction of travel is higher with a lull. Does that trajectory seem reasonable to you?
Well, I agree with the volatility kind of muddling through for the next few months, but I'm less optimistic on a 12-month view. I think, it's easy to get excited by a lower than expected CPI print. By the way, you could attribute all of that lower than expected print to airfare and used car prices. But if we really zoom back out, I think April is likely to be a cyclical trough for inflation, with the tariff impact really coming through in the rest of the year. And I think we exit the year with CPI, core CPI, around 4%. I don't think the Fed is going to cut rates at all this year, which is obviously different from market expectations. And I think what people are missing here is you're going to have higher inflation, probably higher unemployment, and you're going to have growth. I don't think we get a recession, but I think you get U.S. economic growth that slows to a level below 1%. That's not a great environment for equities. They're already trading at 21, 22 times forward earnings on an earnings expectation that might be too optimistic.
Yeah, I mean, there are some people who don't expect the Fed to cut this year. There's some people, I was looking at, Citi expects the Fed to cut from July through January, right? So 125 basis points. What does that mean for growth, the growth side of the Fed's mandate?
Yeah, I think the Fed's going to have a real challenge this year. Basically, you've got a dual mandate that for the last 3.5, 4 years, the Fed said price stability is a precondition for maximum employment. Now, that was a different environment. At that point, they were talking about unemployment at or below 4% in discussing price stability in that context where inflation was way above 2%. I think as we get toward the end of the year, we're going to have unemployment closer to 5 and inflation running closer to 4. And it's going to be a real quandary for the Fed. But given what they've said for the last 4 years, it's kind of hard for them to turn on a dime and say, well, now unemployment's more important.
Right.
If you get unemployment at 5.5, 6, then I think the balance shifts.
All right, so unemployment at 5%, inflation at 4% by year end. Hold that thought. We are just getting started here. Ron Temple of Lazard stays with us through the opening bell, and here is the setup as we head in. You can see the S&P 500. It's pretty much flat. We were down a little bit pre-market. Now we're a little bit higher. The NASDAQ 100.
Yesterday, we were up 3.25%.
We absolutely crushed it yesterday, so some of that enthusiasm coming back a little bit. Big tech higher, though, and the small caps, the Russell 2000, by 0.6%. The opening bell is up next. This is Open Interest.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
We are moments away from the start of cash trade. This is Bloomberg Open Interest. I'm Matt Miller. You can see that we have a slight gain on the S&P futures. We had a 3.25% gain in the session yesterday, so massive rise on the S&P already in there. The NASDAQ futures up 0.25%. Russell 2000 small caps up 0.5%. We hear the opening bells on the New York Stock Exchange. Fabrinet ringing the opening bells. FN the ticker, and they're celebrating 15 years of their listing on the New York Stock Exchange, in which the stock has climbed more than 2,000% to almost $8 billion in market cap. So some very happy folks there. Down on the NASDAQ, America on Tech is some sort of organization dealing with STEM and kids. Katie, in terms of the stocks to watch, I see UNH getting decimated today.
Absolutely. This is the biggest corporate story of today. That's United Health, sinking in a big way after suspending its outlook for the year. The insurer also named board chairman Stephen Hemsley as its new CEO, replacing Andrew Whitty. So sort of a double whammy for investors there. Matt, like you said, more than decimated right now, down 11% on United Health.
And it's already had a rough month, down 40%, you were telling us earlier, because they cut their forecast. Now they've pulled it, so losing basically half of their value in 4 weeks trade. Coinbase is jumping, going the other direction. This after Standard & Poor's announced it will replace Discover Financial in the S&P 500 benchmark index. So a real changing of the guard there from an old economy financial to a crypto exchange. I guess make of that what you will, as Bitcoin trades at $100,000. Ron Temple of Lazard is still with us. And Ron, Sonali Basak, our co-anchor, has just interviewed Ken Griffin, and he was making a comment about the fact that maybe you would be better off having held cash from Liberation Day. It's antithetical to the way we're all kind of raised in this financial markets industry, right? You want to be always playing offense. You want to be always invested to some extent. But what do you make of that? This kind of volatility is difficult.
Yeah, it definitely causes some sleepless nights. And I think cash is an important role for every investor, but they have to determine how much is right for them in their individual situation. Having said that, over the long run, we do know that being invested in equities, whether it's public or private, is a better place to be than cash and delivers higher real returns. I also do think at current interest rate levels, you can argue for investment-grade credit, you can argue for other assets, but one thing that's interesting is year-to-date, the S&P is almost back to flat, but don't forget non-U.S. equities. I mean, the DAX is up 27% in U.S. dollar terms year-to-date. If you look at the CAC in France, up 15, the UK, FTSE 100 up 11. There's a world of opportunity outside the U.S., and I do think even though we're getting this reprieve rally right now because the tariff risk looks a little less bad than it was before, it's still a risk to the U.S. economy. And I think investors would be well suited to look beyond the U.S. and consider other equity markets.
Well, you think about some of those levels that you're talking about, a 27% rally when it comes to the DAX. Is that justified? I mean, if you had been doing so well in the DAX right now, would now be the time to take profit, or do you think that there's actually more room to run there?
And I should have been clear, that's in U.S. dollar terms. So about 10 percentage points of that is the dollar weakening against the euro. But I think your point is a great question. I look at the European markets and think this might be a watershed moment for Europe. What we've seen in the last few months, partly in response to the new administration in the U.S., but the German fiscal U-turn, I never thought we would see that, especially after we saw the election results.
I was really
guess
surprised.
I should have listed.
I mean, look, no. I was surprised as well, and this is one of those areas where a lot of people, even those who didn't vote for Donald Trump, say you've got to give, to some extent, this guy some credit, right? These policies, even if you think that they're erratic, if you don't think they're based on solid economic theory, if you think they're volatile and wishy-washy, they still have brought about some pretty great results. Is the inflation number part of that? Is this still Biden's economy, or does Trump get to take credit for lower inflation, as he does so often on Truth Social?
I think it's a flawed assessment to try to kind of always ascribe a certain macro number to the current guy sitting in the White House, well, sadly, it's always been a guy, so I guess safe to say the guy.
Yeah.
But bottom line is, these numbers largely reflect the legacy, I would say, of Biden, plus some of the early influence of Trump. You're in that gray zone, but I think what's going to become clear, the reason I say don't get too excited about these numbers, is all of the importers in the U.S. who buy a lot of products from China knew that tariffs were coming on China. I think what surprised people was the tariffs on Canada and Mexico, right? We weren't expecting, I mean, by the way, to be fair, Trump did campaign saying he was going to put a 10% universal tariff in, and he did, so none of us should have been surprised. But my point is, importers front-loaded their orders. And so you haven't really seen the impact of those 30% plus tariff increases on China. That's going to come over time, and that would be clearly ascribed to the current administration because you can connect the dots from policy to reality that comes out of it. I think the challenge with today's inflation report, used car prices being down a little bit, I think used car prices are going to go up because of tariffs, as are new car prices. We already heard from Ford.
Right.
Airfares being down, you could argue that's a sign of weakening economy and people buying fewer plane tickets on a discretionary basis. So how do you allocate credit or blame? Hard to say.
Yeah, it seems like this is a not yet report, to steal a phrase from Mike McKee. I want to bring this conversation back to U.S. benchmarks because you mentioned the S&P 500 pretty much flat on the year from a pretty significant valley. What's not flat on the year, even though it's had a big bounce back, is the Russell 2000 in orange right there, still down about 6% or so for 2025. There's been a lot of false dawns for Europe. There's been just as many for small caps. Does this ever change?
I think there's opportunity in small caps. The problem is the thesis has been evolving over time. In my experience as an investor, an evolving thesis often means a broken thesis. But in the case of small cap, where I see the opportunity is not at the index level. I think there's a real opportunity in being active. You look at the Russell 2000, 40% of the companies lose money. You've got a lot of really low quality companies, some of whom might someday end up being, 1,000% gainer because they make it to the next level, but many of them fall by the wayside and never make it. And so I think you really want to have more of a quality filter looking at the small cap universe. Maybe S&P 600 is a better metric because there are kind of profitability requirements in that index. But bottom line, I would engage it actively. And I do think some companies might be less susceptible to the trade issues. Some companies with better balance sheets might be less vulnerable to higher interest rates for longer. So it's really a security selection game there.
Yeah, I think it's fair to say that maybe index tracking is better for just larger cap companies, right? And when you're talking about these small caps that can so easily go bankrupt, that are so reliant on financing, you've got to look at them company by company.
And there's a lot less sell-side coverage of these companies too, so a lot more inefficiency. This has always been the argument for non-U.S. over U.S. in terms of being active. Emerging markets, small cap, in spades, because you don't have that coverage like you've got where you've got 50 analysts covering a mega cap tech company in the U.S.
Ron, great.
I gotta say, if you're a small cap manager actively with a strong stomach, this sounds like a lot of fun.
Yes. Yeah, no, it does sound like a ton of fun. And obviously, because there's so many interesting companies that could go to the moon, right? But there are also a lot that could go bust.
Do the opposite of that.
Ron, really great having you here. Thank you so much for joining us. Ron Temple there of Lazard. We got to get you back very soon here. Katie, you're going to take a look at what's going on with stocks.
Yeah, let's take a look at the breakdown of this market because we're pretty much flat when it comes to the S&P 500. But then you take a look at the breadth. It's pretty much an even split. You do have 200 names, close 297 names in the green right now, 200 in the red. You can see that the ones who are leading the way or trying to push this benchmark higher, it's your big tech names, NVIDIA, Amazon, Meta, Broadcom, all trying to pull their weight here. You take a look at the downside, though. You have United, as you would expect, one of the biggest losers right now, especially from a points basis, Microsoft, Alphabet as well on the downside. And this is broadly what you're going to see if we take a look at the sector level as well. Pretty much an even split when it comes to what's gaining, what's losing. A little bit more in the green. You have consumer discretionary and big tech up top. And then you go down the list, utilities, staples, real estate, and healthcare. And let's actually click into healthcare right now, and you can see just how big of a weight United Health is. All the way at the bottom here, down about 11.6%. They pulled their guidance. They have a new CEO. They're bringing back the old CEO. And you can see that investors really shook by this news. Now, coming up, as we're talking about, that shakeup at United Health catches investors by surprise. We'll give you more details next. This is Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Welcome back to Open Interest, a check on stocks right now. You can see the S&P 500 pretty much at session highs, higher by 0.3%. That will probably be good enough to put us back in positive or at least unchanged territory for the year. And you can see big tech is doing a lot of pulling right now. The NASDAQ 100 up 0.6%. You do have NVIDIA rallying today. That's helping both of these benchmarks. It's not helping the Russell 2000, but still, you're looking at a gain of about 0.5% when it comes to the small caps. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Caterpillar getting upgraded to a buy over at Baird. That's thanks to its sales stabilization and the easing of tariffs. Next up, Chevron, though, getting downgraded over at HSBC on falling oil prices. The analyst is citing reduced upside for the shares, which are currently off by about 0.4%. And finally, Valero Energy getting upgraded to a buy at Goldman Sachs thanks to improved margins. Meanwhile, let's get back to one of our top stories, and that is United Health Group shares plunging this morning after a shakeup that caught investors by surprise. The insurance giant, it pulled its guidance for the year. It also returned board chairman Stephen Hemsley to the CEO role, replacing Andrew Whitty, effective immediately. Joining us now for more, I'm pleased to say we have Glenn Losev. He is a healthcare analyst for Bloomberg Intelligence. And Glenn, there's two pieces of news this morning. Obviously, they're connected here. Which do you think, though, is the bigger weight on shares? Is it the guidance pull or is it the CEO change?
I think the guidance pull is the biggest puzzle to the investors, especially after the company lowered already very cautious outlook after 1Q results, and now with this announcement today, it's incredible puzzling for investors regarding United and the overall overhang to the health insurance industry as a whole.
Is the problem that they're at this point being too generous with their payouts? Glenn, is this the issue, that they're not taking in enough in premiums and covering too much in terms of medical procedures?
Basically, yes. So United stated today on a conference call that the medical costs from the newly onboarded beneficiaries within their Medicare Advantage plans are much costlier than they anticipated. They also said that the bidding cycle for next year that sort of begins shortly will be enough time for them to recapture the margins next year. That being said, not enough information is available. And on top of that, this issue seems like it's reaccelerated relative to what they reported in 1Q. And also, United was probably the only outlier outside of the rest of health insurance companies that reported this surprising trends during the first quarter.
Well, Glenn, that's what I'm wondering. Of course, United Health is the largest seller of these health plans, but how did they stack up versus some of their peers when it comes to dealing with these issues?
So before the issues began, basically at the start of 2004 with the Change Healthcare cyber attack, the broader issues, United was the 800-pound gorilla and the best operators within the health insurance industry. Obviously, something went wrong over the last, over 12 months, and it seems like since the beginning of 2024, the company is on the back foot trying to fix things that are falling apart. That being said, obviously, United is United, and the opportunity to fix things is there, especially with the current chairman and old former CEO taking the reins once again.
Glenn, great to get some time with you. Thanks so much for joining us. Bloomberg Intelligence healthcare analyst Glenn Losev. You can see his research on BI Go if you're using the terminal. Let's get a look now at some of the individual stock stories that we're following today with Bloomberg's cross-asset reporter, Isabel Lee. Isabel, what are you looking at?
We're looking at Coinbase. So the stock is finally going to be added to the S&P 500, which is a big deal. We have a lot of multiple proponents saying that this is a sign of times, really a sign that there's broader acceptance for digital assets. And we've got everyone from Microsoft Michael Saylor to Kathy Wood, really congratulating the CEO, Brian Armstrong. And Armstrong, for his part, made the point that this is a big deal because crypto is about to be in everyone's 401k. So shares are surging there, up by almost 15%. Up next is On. So On is raising its sales growth forecast to at least 28% in 2025. That's driven by strong demand. Despite the uncertainty, I know that some of the people here are fans of Hoka.
But indeed, you can name names.
One of the people here is a big fan of Hoka.
Indeed. Okay. So, but this company is backed by Roger Federer, and it's really become one of the top performers in the sneaker world. And it's expanded to tennis, to apparel, and everything. And it's been founded in 2010, but I feel like its rise really just began since the last few years. But still, it's really a big deal. Stifel called the results impressive. Truist said that they handily beat revenue. So, good news for On. And last, we're looking at Rigetti. This is the opposite because we see shares going the opposite direction, down by as much as 10%. Rigetti tumbled after missing revenue expectations. Operating loss was also larger than forecast. It did report a profit, but that was really just an accounting gain. So the CEO said that revenue can be, quote, lumpy. He said that quantum computing really continues to be in R&D mode. And the company did notch a handful of contracts this year from the US and the UK.
All right, Isabel, great roundup as always. That is Bloomberg's Isabel Lee. I do want to quickly take a look at shares of Hertz right now, down by about 20%. This is after the car rental company posted a larger than expected loss in the first quarter, pressured by a slowdown in consumer bookings. Revenue fell 13% in the period. You added together shares down 18%. Certainly, this has been quite a volatile company to watch.
Yeah, absolutely. Big surge in the middle of April, and the expectation is that if we see inflation, it's going to drive up the value of the fleet that Hertz owns, right? That's also the problem with Hertz, because they spent so much money buying Teslas that the value of their fleet plummeted. But now that we see less inflation, maybe that's not a great play. So Hertz today is going to be hurting.
Yeah, certainly. I will say Hertz, through yesterday's close, was higher by about 90% through the year. Obviously, a big chunk of that is coming out this morning. But coming up, the U.S. is set to boost Saudi Arabia's access to semiconductors. We'll take a look at the deal next. But before we get there, one lingering question hanging over U.S.-China tensions is whether Washington might broaden China's access to U.S. chips. Ken Griffin discussed this topic with Janali Bassick for an episode of her upcoming series, Bullish.
Does it serve the interests of the United States to reduce Chinese access to the most modern of semiconductors? That's a really interesting and ongoing debate. And I could frankly argue both sides of that debate. The key, from my perspective, is consistency of policy is important. And in particular, we need to make it clear to our allies that whatever policy that we arrive at with respect to China does not define the way in which we will treat our allies.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Welcome back to Bloomberg Open Interest. I'm Matt Miller. Let's get a check on where stocks are just 22 minutes into the session. You can see the S&P 500 putting up solid gains. I mean, after 3.25% yesterday, we're up another third of 1% at 58.63. So getting back up towards those all-time highs of 6,000, 6,100 that we saw at the beginning of the year. The NASDAQ 100 also gaining 0.75%. So bigger gainers on the tech side. And that's really what we've seen. Mag 7 like powering this rally again. In terms of the individual movers, Coinbase is one of those gainers that represents, I think, a changing of the guard, right? They're in the S&P 500 now, or they're going to be, and they're going to replace an old economy company, Discover Financial. We just heard about Rigetti Computing from Isabel. It's only a $3 billion company, but still worth pointing out it's getting absolutely decimated. So is United Health Group. In fact, more. It's down 14% after pulling its guidance and replacing its CEO with a former CEO. On Holding is like a shoe company. Boeing is like essentially a state-owned duopoly. And NVIDIA up 3.25%. Now that's one of those big, heavy tech companies that really powers, Katie, this rally higher.
Absolutely. For more on the chip makers, we're joined by Bloomberg Technology co-host Caroline Hyde. We had a great Bloomberg scoop out this morning that the Trump administration preparing to announce a deal granting Saudi Arabia more access to advanced semiconductors. I have to think that's what's helping NVIDIA rise so much this morning.
NVIDIA, AMD as well. Both of those CEOs are in Saudi Arabia at the moment at the big conference that's happening at the same time as the president is there. And we are feeling that in but fewer hours, we could see this unveiling that Saudi Arabia will have more access to the most powerful chips. This is the undoing of the so-called AI diffusion rule, actually allowing allies to have access. Now, since 2023, you had to go and get a license if you wanted to sell into Saudi Arabia, into the UAE. Why? Because there's a worry that they were somehow managing to either redistribute those chips onto China or indeed allow China to access the compute via the cloud. So there are still some details to wield out here. Will we see that American data centers could be owned and controlled by America if they are indeed holding NVIDIA or AMD chips? Or indeed you have a so-called sort of data center embassy where instead of following local law in Saudi Arabia, they instead are dictated by perhaps America's laws. So there are some ways and means that they're going to be able to do this. But it's Saudi Arabia and also the UAE we're anticipating could be unveiled of being able to access these really sophisticated chips.
By the way, speaking of Saudi Arabia, I shouldn't be so flippant on Boeing. And Katie, part of your job is to say, Matt, don't be so flippant.
It's not a duopoly.
It's a publicly traded company in a very competitive environment.
Exactly.
And Saudi Arabia, of course, ordering 30 737s from Boeing, which is the reason that you see those gains. I want to ask you about another company completely, Caroline, and that is Google. You were talking, I think, yesterday about the fact that they may not be able to pay Apple $20 billion anymore. Well, they could turn around and use that money to fund a lawsuit they're facing in Europe. I think 12 billion euros on people that feel like they've been bilked.
Yeah, and civil lawsuits here that could really end up adding up. 12 billion euros, you have to put in the context of things, isn't a vast amount when you're comparing them to the quarterly revenue of a company like that.
Less than what they pay Apple annually.
But surprise, surprise, once again, it is the EU getting tough on some of these big tech companies. Remember, that comes in the context of tariffs, of the EU and US in combative relationship. And more broadly, Trump has not liked the way in which the EU has been forcing different laws upon some of the biggest technology and digital services offerers. So we'll have to see how that unfolds. But 12 billion euros for a civil suit, that could be significant.
All right, Caroline Hyde, thanks very much for that. Co-anchor of Bloomberg Technology. You can catch her program every day at 11 a.m. Coming up in the next hour, more on President Trump's trip to the Middle East, and we'll speak with Wendy Schiller of Brown. This is Open Interest.
asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. New Trump tariffs be darned. The rate of annual inflation through April was the lowest since February of 2021. The Labor Department reports the Consumer Price Index rose 2.3% year over year. That's below what economists expected. CBS's Kelly O'Grady.
A couple of the items that stood out to me, shelter has been peskily high. That is responsible for a lot of the increase. But groceries, food at home, that actually came down. It was negative 0.1%. Eggs was down close to 13% month over month.
Many analysts do expect inflation to pick up. Just hours after he arrived in Riyadh, there's word President Trump and Crown Prince Mohammed bin Salman have signed a strategic economic partnership. Correspondent Weijia Zhang is there.
This president views every relationship with a business lens, so it's not just about security here for his priorities. It's about making money.
Mr. Trump will spend 4 days in the Middle East. Sean Combs' ex-girlfriend Cassie Ventura could take the stand as soon as today at the rapper's sex crimes trial. Criminal defense attorney Caroline Polisi on the prosecution's likely strategy.
They will try to present a theme, which is potentially a wearing down of Cassie's sort of spirit and her ability to fight back.
Combs faces life in prison if he's convicted of racketeering and sex trafficking. Kim Kardashian is testifying at the trial of a group of armed robbers who tied her up in her Paris hotel room 9 years ago. CBS's Elaine Cobb reports from Paris.
The reality TV star mounted the steps to the courthouse as though she were in Cannes, flanked by bodyguards and her own photographer. As she arrived at the top of the steps, she turned, took off her dark sunglasses and smiled and waved. In court, she wiped away tears as she told the judge she has never really felt safe since that night.
Kardashian told one defendant she forgives him. Farmers will have valuable information affecting their businesses restored.
When President Trump took office earlier this year, the Agriculture Department's website deleted maps showing how climate change might bring floods, droughts, heat waves, and wildfires. It also scrubbed information about federal loans for farmers and rural clean energy projects. A farming association and 2 environmental groups filed a lawsuit in February to have all that information restored online. The administration has agreed to put it back up within 2 weeks. Michael Wallace, CBS News. News.
Fiery lava fountains and glowing ash clouds lit up the sky over Sicily. Eruptions are intensifying from Europe's most active volcano, Mount Etna. The Dow is down 165. This is CBS News. You turn to when you have questions about your money.
A new Gallup poll finds 43% seek out financial advice from friends and family. 41% use financial advisors and planners. 32% lean on banks and credit unions. The poll finds 20% look to podcasts, books, or social media. Just 12% investigate government resources. Gallup says young adults report a greater reliance on friends and family and digital sources than on financial advisors. The opposite is true of older adults and seniors. Steve Kathan, CBS News.
No comment from Health Secretary Kennedy over his chosen swimming hole on Mother's Day. He posted pictures to X from a Sunday hike with some of his kids and grandkids in Washington, D.C.'s Dumbarton Oak Park. Some feature RFK Jr. and the little ones wading in the contaminated Rock Creek, where swimming's banned because of high bacteria levels. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live. That's where you'll find us. President Trump is in the Middle East. He's in Saudi Arabia, and he had some meetings today, and we're expecting some comments from the president from Saudi Arabia, and we'll bring that to you live when it occurs in the coming moments. Coming up, we're also going to check in with Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Let's see what he thinks about this inflation data. It seemed pretty tame to me. Sarah Ponczek, financial advisor at UBS Private Wealth Management, will give us her thoughts on these markets. Is she buying this rebound here for her good friends at UBS? Sam Daher, Bloomberg senior Middle East reporter, talking about some of the deals that President Trump is negotiating with the folks in the Middle East. We got all that coming up, as well as some economic data as well. But right now, let's kick this whole thing off with John Tucker and a Bloomberg Business Flash. John.
All right, and this Bloomberg Business Flash, Paul, being brought to you by IBKR. Will the year-over-year change in the U.S. CPI exceed 2.7% in May of 2025? At IBKR Forecast Trader, the yes was recently at 23%. Start predicting today at ibkr.com/forecast. The last trading day for this contract is June 19th. The S&P 500 rising toward its highest level since February. Just parenthetically, it's still down 4.5% from its record. 7 of the 11 major industry groups in the index, they are higher right now. And you guessed it, healthcare, the biggest drag for the S&P 500, also the biggest drag for the Dow. That's because of United Health Group. It is down, those shares right now, 14%. Christine's going to be along in a few minutes just to tell you why. Household inflation posting a smaller than expected forecast increase for the third month in a row. Despite the tariffs, the consumer price index rising a modest 0.2% in April. The more policy reactive 2-year yield right now down 2 basis points. That's at 3.98. The 10 unchanged, 4.47. Also seeing a dollar DXY that was down about 0.4%. Bank of America Corporation planning to open more than 150 new branches. When was the last time you were in a bank branch? By the end of 2027.
Supposedly my husband goes into them. I don't.
I mean, I do, right here because the ATM machine, but like meet with for what? Anyway, the second largest U.S. bank pushing further into growing markets. More than 90% of client interactions do take place through a digital channel. The branches, they say, are going to focus more on meeting spaces where conversations can take place. So,
okay.
There you go. S&P 500, 33 points higher. That's up 0.6%. 58.78 on the index. The Dow Jones Industrial Average right now down 143. The NASDAQ 100 after yesterday's incredible over 4% surge. Right now the NASDAQ is up, NASDAQ 100 up 1%, up 228 points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Hi, Alex and Paul.
Hello. Happy Tuesday. Alex Steele here alongside John Tucker and Paul Sweeney. It's Tuesday. We got this. All right, let's take a look at some of the stocks on the move today. I'm Alex Steele with Paul Sweeney, and we're joined now by Bloomberg's Christine Aquino. Let's talk about the biggest decliner that's leading the Dow Jones Industrial Average lower. That is United Health.
United Health, Alex, that is down more than 14% now. So those opening losses really picking up steam here. And the big news is the fact that it unexpectedly replaced its CEO and brought back its former CEO and chairman, Stephen Hemsley. Now, Hemsley, of course, is a United Health veteran. He joined in 1997, served as CEO for about a decade starting in 2006. Now, United Health has had one heck of a time. They suspended their earnings guidance as well for this year, citing higher than expected medical costs for some of its beneficiaries. And as we remember, last month, they cut their annual guidance and reported their first earnings miss in more than a decade. So it sounds like a lot of turmoil over there.
Yeah, just, I mean, the old withdrawing the guidance, new CEO, boy, that is just bad. So that I can see how the stock's reacting to that. How about our good friends at Boeing? Some good news there?
Yeah, some good news at Boeing. A couple of Bloomberg News reports actually contributing to the share gains there potentially. We're up now more than 2%, nearing 3%. So those gains picking up steam from the open. So one Bloomberg News report saying that China has removed a month-long ban on airlines from taking delivery of Boeing planes. So that follows, of course, the more cordial relations between U.S. and China after some trade talks over the weekend. And then we have another Bloomberg News report also saying that Saudi Arabia's sovereign wealth fund will be ordering 30 737 MAX jets for its aircraft leasing company, Avilease, and that is just in time for President Donald Trump to be heading to the Middle East.
All right, let's wrap it up here with Enphase. So that is a solar company, and we had revisions within the GOP tax bill about some of the IRA tax credits. Walk me through it.
Yeah, exactly. Enphase now extending those losses down more than 4% since the open. And exactly that, Alex. Enphase really among the kind of companies that are at risk if this tax bill passes and makes it through the House and the Senate. So basically BMO cutting its recommendation precisely because of that. They're now seeing the stock as an underperform, and they're citing those proposed tax changes, potentially a plan to eliminate credit for homeowners who take loans or pay cash for their residential solar and battery systems. So they're thinking Enphase really going to take the brunt of that pain.
Yeah, you know what else is really going to hurt? Hydrogen.
Oh.
The 45V tax credits also going away. That's really hurting some companies, or will hurt some companies. But, you know, some are saying it's not as bad as it could have been.
Okay.
And it's all in negotiation, so maybe it won't be as bad. For more conversations just like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes and the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. Christine, thanks a lot. Bloomberg's Christine Aquino. Let's get to the bond market here. So we had CPI came in better than expected, yet you have yields lower by 2 basis points in the front end. Head scratcher for me, Ira Jersey, Bloomberg Intelligence, a senior U.S. interest rate strategist. So in my 1 + 1 = 2, you get inflation less of a problem. Therefore, the Fed won't have to cut. Why are my yields lower here?
Well, it's not only that the Fed won't have to cut, but that the Fed can maybe cut a little bit, right? So lower inflation and inflation below target or at their target is a necessary condition for the Federal Reserve to cut. So the fact that you only had a 0.2% month on month on inflation, not a massive surprise. Quite frankly, it wasn't a huge miss really when you look at a lot of the details. But it was also a good sign because people are worried that tariffs are going to have an effect. But remember, the tariffs only went into effect last month. So we're not going to see that on shelf prices until this month and next month. So I think the market in general, like this relatively muted reaction from the market is something that we're going to have to look through, at least on the inflation front, for the next until we get the prints from the next couple of months.
What's the Fed looking at, Ira, these days? Is it focusing more on inflation or more on growth? Because I think a lot of folks are probably concerned that whatever inflation levels we get, it's going to kind of hurt growth more so. What do you think the Fed's looking at?
Yeah, well, this is certainly the conundrum that the Federal Reserve is going to have going forward, particularly if we get an increase in inflation and then we see a significant downshift in growth and certainly the job market, right? Remember, the growth itself is not what the Federal Reserve's mandate is. It's really the job market. So you can have slow growth or no growth with a job market that's okay, but not great. And I think that's the potential, big issues that the Fed might go to. So Jay Powell last week was pretty clear in saying that, look, we're going to basically focus on whichever of the two parts of our dual mandate is farther from where we want it to be. So if inflation jumps to 5% and unemployment is still kind of 4.5% and not climbing quickly, then they're going to focus on inflation. But if inflation kind of hovers 2.5%, 3%, but it looks like we're going to have negative job prints and we're going to have 5+% unemployment rate, then the Fed will key on that and cut interest rates and maybe give up a little bit on its inflation fighting mode for at least some temporary period of time. But we're still far away from that. I mean, our view had been going into this year, and I think I mentioned it to you guys last week, is that we always thought that the market was pricing for the Fed to cut too early. Cutting in June or July, we never thought was a realistic possibility because of this, dueling economic scenarios that you just laid out, Paul. So now we're probably pricing for something a bit more realistic. Fourth quarter, only 2 cuts this year. That's kind of where we think the market's going to kind of find a steady state.
So does that mean that around 4% is the top for the 2-year?
Yeah, I think it is, unless we wind up getting some better economic data. So, we get an upside surprise on next month's employment, and we wind up having decent retail sales data, all of those things. I don't think that anything above 420 probably on the 2-year makes sense. Like, there's no reason right now for the 2-year to be trading above the federal funds rate, right? So why would you sell off 50 basis points in the 2-year unless you really thought the Fed was going to hike, which I think is not realistic. It's much more likely that they stay steady for the next 2 years than it is that they increase rates at any time over the next 2 years. That being said, just the financial fair value right now on the 2-year note, we have at 3.8%. So maybe the market's gone just a little bit too far, being very close to 4% right now.
Ira, are international investors still buying U.S. Treasuries, or are they still mad at us?
No, they are. And in fact, if you look at the recent Treasury auctions, they have been purchasing just the same amount that they had been over the past couple of years, actually. Around 10% of the recent Treasury auctions went to foreign investors, and that's pretty much in line. Some of the investors that I've been speaking to say, well, look, it's an economic decision that we're making. If our choice is to buy our local government debt or buy treasuries and then hedge some of our currency risk or all of our currency risk, and we can still pick up yield compared to our home currency and our home bond market, then we're going to keep doing that trade. And so until that economics changes or there's real fear that the U.S. is going to default on its debt or something like that, I think private foreign investors in particular are just going to keep buying.
Hey, Ira, always good to catch up. Ira Jersey, Bloomberg Intelligence senior U.S. interest rate strategist, joining us. There are some headlines coming to us from Saudi Arabia that NVIDIA is going to build some AI factories in Saudi Arabia. Boeing 737A aircraft totaling about $4.8 billion are going to be sent to Saudi Arabia. And GE Vernova's energy solutions worth over $14 billion to Saudi Arabia as well. We're going to get more headlines and sort of what's at risk and what's at stake for Saudi Arabia and the U.S. As President Trump marks his first overseas visit aside from the Pope's funeral. We are going to break that down with Nick Wadhams. He joins us from Bloomberg Intelligence. He is the national security team leader. Plus, what do you do when you're like a couple points away from erasing all the declines for the S&P that caught many, many investors and hedge funds off guard? What do you do? Sarah Ponzik, financial advisor at UBS Private Wealth Management, will be joining us. Happy Tuesday. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 has now erased its losses for 2025. Just parenthetically, I should point out, it's still down, 4.1% from its record close. Again, the index is pushing higher today. 6 of the 11 major industry groups in the S&P 500 are up. Tech shares, they're leading the way. And then United Health Group, this is another story. Big drag today, unexpectedly replacing its chief executive officer and suspending its earnings guidance. Worst performing stock in the S&P 500 and the Dow Jones Industrial Average today. Shares of United Health Group, they are down 14.3%. Incidentally, it's also the worst performing stock in the Dow Jones Industrial Average year to date. We have the Treasury scene right now. 2-year yield, as Alex pointed out, down 1 basis point, right below 4. Well, let's call it 4%. U.S. inflation rising less than forecast for the month of April. CPI increasing 0.2% from March, driven by tame prices for clothing and new cars. So this came in the rate of inflation less than expected by economists surveyed by Bloomberg. Once again, the S&P 500, 43 points higher. That's up 0.75%, 58.87 on the index. The Dow Jones Industrial Average, 75 points lower. The NASDAQ 100 is up 264 points. Another 1.25% jump. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I tell you, as John was just reporting, the Dow's off 78 points, but if you take out United Healthcare, which is United Healthcare accounts for minus 285 points in the Dow, so the Dow would actually be up here if it weren't for United Healthcare. So pretty solid day after a big move yesterday in the equity indices. Let's see what the professionals are doing. Sarah Ponsick joins us, first Vice President of Wealth Management at UBS Private Wealth Management. She's down there in Boca Raton, Florida. All right, if you care, 82 and mostly sunny in Boca today. I mean, if that's your gig, fine, enjoy it. I don't know. We go for the change of seasons here, which Sarah does
He's
not.
He's just jealous, Sarah. This is all that this
is. Sarah.
You're jealous. No, if I make you feel any better, we had a really bad storm yesterday. I had palm fronds all over the house. So,
it happens.
So today's sunny and warm and humid, but we are starting to get some good rain.
Good for our good friends in South Florida there. Hey, Sarah, what do you tell your clients? I mean, boy, you've had a market that just a few weeks ago was down 20% from its peak. Now, just year to date, we're back to flat or slightly up here. I mean, the volatility has been amazing. What do you tell your clients these days?
It's been a whirlwind these past 6 weeks or so, however long it's been. It feels like it's been a lot longer than that, I think for all of us. But the message throughout April, which was really the month in which we saw the brunt of the volatility, was that you need to stick with your plan, and you certainly don't want to be selling out of stocks at the lows. If anything, if you were someone who had a liquidity event, if you had been sitting on cash for a long time, that was the time you wanted to start phasing into markets and start deploying your capital and taking advantage of the volatility. Because yes, Liberation Day was certainly a day I'm sure we all remember, a very volatile one at that. But the expectation was that was peak uncertainty. That was peak pessimism. And the hope was that there would be negotiations that we would see come to the forefront between the United States and other countries, particularly China, and that we would see these tariff rates come down. Now, thankfully, that is what's happened, and we've seen markets react very favorably to that. At this point in time, you, Alex, you just ran through the numbers. Really, it's as if markets have made up all of those losses. It's pretty amazing to think about, considering the S&P at a time was almost down 20% at its low, and now we're just about flat. So sure, at this point, the risk reward doesn't look quite as favorable as it looked when the market was down 10, 15, 18%. But the outlook is still pretty positive from here, especially with the expectation that, hopefully trade negotiations will continue. And, growth is slowing a bit. Inflation, is under control, as we saw this morning. So there's other reasons fundamentally to continue to think that, 12 months from now, the market's going to be higher than where we are today.
So if the calls you were getting a month ago were, what do I do? What's changing? I'm kind of freaking out. What are the calls you're getting now today?
Well, people certainly feel better. It's really interesting. You know, typically investors, we all know that you want to be fearful when people are greedy and greedy when people are fearful. But in actuality, you know, people don't always act that way. You know, it's interesting that, you know, the calls that we were getting at the April lows when markets were down between 15 and 20% were more panicky, asking, do we need to change our strategy? What should we be doing here? Should we be selling stocks, buying bonds, buying gold? And we did make some tweaks, but certainly weren't selling stocks at those levels. It was more so talking about adding at those levels. Now people feel better. You know, people, it's interesting. You would think that when markets are at the highs, people are saying, should I take chips off the table? But that's not necessarily the case. People feel better. People feel more optimistic now that we're seeing, you know, countries come to the table and discuss and these tariff rates come down. With that said, I mean, I'm actually about to have a conversation with a client who has a big home purchase coming up over the next couple of months. That's someone, given that we've seen a rally, that you might want to consider taking chips off the table. If you have a big near-term purchase coming up and you need liquidity, you need cash, okay, you probably feel pretty great now. You're not selling with stocks down 15%. You're selling with them flat now on the year, roughly. So that if you're someone who has something like that coming up, that changes the parameters. But we typically like to say, you know, to clients who have near-term events where they need cash on hand, or if you're someone who is retired and you're spending down your portfolio, we typically recommend that you have a liquidity buffer in your portfolio. Say, you know, for whatever that project is, or say, you know, even 2 to 3 years of expenses, because that way when the market does fall, and it's going to happen, it's natural. You know, we're all going to witness many more of these in our lifetimes, right, most likely. You know, that way you're not freaking out because you know you have the cash on hand to meet the expense needs that you need in the near term.
Sarah, thank you so much for joining us. Always appreciate getting a few minutes of your time. Sarah Ponczek, First Vice President of Wealth Management at UBS Private Wealth Management down there in Boca Raton, Florida. Red headline crossing the Bloomberg terminal. Microsoft cutting 3% of all workers. That's according to CNBC. And we'll bring you further reporting on that. Let's get back over to the Middle East. President Trump in the Middle East, Saudi Arabia today, cutting some economic deals here of some note here. We want to check in with Nick Wadhams, Bloomberg National Security Team Leader. Nick, this seems to be a trip, not so much diplomatic trip, but more of an economic development type of visit for President Trump to that region of the world. What did you make of day one?
Well, this is very much in line with what we were expecting. Actually, in some ways, it's a little bit of a loss for President Trump. I mean, listen, he had wanted to go to Saudi Arabia, obviously the important ally, important partner, also a lot of overlapping business interests between the kingdom and Trump's own family, namely his son-in-law, Jared Kushner. But really, this was part of his idea that foreign policy is about making deals that are good for the U.S. So he wanted to come with a big splashy number, and he had actually said, you know, when I go to Saudi Arabia, I want to see $1 trillion in deals. I didn't get there. He got $600 billion in investments from Saudi Arabia, and now the process begins that we're just sort of in the thick of sorting through how much of this is actually new. You know, a lot of times it wouldn't be just necessarily Donald Trump, but presidents going back decades have packaged deals like this, stitched together previously announced and previously committed stuff. So we're sort of in the process of sorting through a lot of that.
What do the Saudis want from us?
You know, that's a great question. A couple things. They want continued U.S. investment. They want a defense partnership. Saudi Arabia wants to build out a civilian nuclear program, so they want a commitment from the U.S. to assist with that. And they basically want the U.S. to not to turn away from Saudi Arabia. So, you know, this is something they see that the quickest way to Trump's heart is to do a lot of these deals to give him exactly what he wants. You know, they have a lot of money to throw around. They want to invest in the United States and technology. They want NVIDIA chips. So there's a big laundry list of stuff, not to mention advanced weaponry. So, you know, they're going to need Trump's blessing for all of those things.
So we've got Brent crude That's $66 a barrel. I'll defer to Alex on that, but I mean, oil's not probably where the Saudis want to see it here. So, how is their economic bargaining position right now, do you think?
Well, this is a really fascinating issue because there was a lot of tension during the Biden administration with Saudi Arabia around what OPEC was going to do. Obviously, Biden wanted low oil prices, especially as he tried to put the squeeze on countries like Iran and Venezuela and others, and obviously Russia. So then there was a contretemps during the Biden term where Saudi Arabia OPEC wanted to cut output to goose oil prices, and that was something the U.S. didn't want. So there was a lot of behind-the-scenes tough talk between those two governments. So, I think you could see a similar thing here. Obviously, Trump really does not want oil getting a lot higher, especially as he looks at the possibility of new sanctions on Russia if Vladimir Putin doesn't commit to a deal with Ukraine. So I think you're going to see a big question here where he may really press the Saudis. Listen, don't fiddle with that dial on oil and trying to restrict oil output.
I mean, they're not. The Saudis most definitely are not. They're obviously also putting some pressure on their own partners that have not been abiding by their quota. So it's like a weird, perfect marriage in that respect. In terms of the company angles here, Nick, what companies so far have either been involved in these deals? And there was a headline about NVIDIA selling chips to the Saudis. Can you walk us through that?
Yeah, I mean, there are a few things. So the big prize here for Saudi Arabia is those chips, and that is certainly not a done deal yet. Saudi Arabia wants those chips, but the Trump administration is still working its way around rules imposed under the Biden administration that put restrictions on exports to some of the highest level chips. But, we're now seeing, though, that there's about an $80 billion plan for investment by Google, Oracle, Salesforce, AMD, Uber, and DataVolt. So, again, the question here is really trying to figure out how much of these commitments are just on paper and how much of them are actually going to go through. That big top line number of $600 billion, that fits with what Saudi Arabia had said it wanted to do over the next 4 years and enhance trade and investment with the U.S. So, there's definitely a messaging issue here where Saudi Arabia had previously said, okay, we're preparing $600 billion. We got to find some place to put all of our money. The U.S. is the best place to do that. Let's do $600 billion. Now they're sort of saying, presenting this as a Trump victory.
All right. Thanks a lot, Nick. Really appreciate Nick Wadhams, Bloomberg National Security Team Leader. Thank you for all of that update. All right, coming up, Sam Dagger is Bloomberg Senior Middle East reporter. We will discuss the relationship of oil, President Trump, and the Saudis after that, and sort of how the diplomacy in the oil market is evolving. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This is Bloomberg Business Flash. And we are being brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Major stock averages, they are mixed right now after data this morning showed the rate of inflation rising less than expected in the consumer price index. Now, the Dow's lower. Let's start there. And the blame goes to United Healthcare. The stock is down right now close to, let's call it 14.5%. United Health Group replacing its CEO, Andrew Whitty, with the former CEO, Stephen Helmsley, citing personal reasons for Whitty's resignation. They also suspended their earnings guidance. Right now, the S&P 500, 39 points higher. That is up 0.7%, 58.84 on the index. So that is, well, just about erased all the declines since the start of the year for the S&P 500. In addition to that, shares of Coinbase, right now they're up 16%. The company replacing Discover Financial Services in the S&P 500. That's going to happen next week. On the flip side, yet shares of Hertz, they are driving lower, down 18.2%. The rental company posting a larger than expected loss in the first quarter. You know, spring is typically the maintenance season for electric grids. Not now, because there's a spring heat wave descending on the central U.S. Austin, Texas, at least according to the National Weather Service, forecast to reach 103 today and 105 tomorrow.
What about Friday? I'm going to be at a refiner in the south.
Oh, like 200 degrees easy.
Oh, fantastic. That
More
feels...
than 130 daily high temperature records may be broken or tied, according to the National Weather Service this week because of this. So you're going to be at a refinery doing what?
Reporting.
Oh, okay.
About refinery things.
Refining.
Yes, exactly.
No, the story is if you have low oil prices, does it translate into low gasoline prices? Mike McKee and I are going to do a combo piece on that.
Crack spreads?
Crack spreads, baby. That's what we're doing.
They call them crack spreads because you're cracking big, long molecules of carbon?
Yeah, you're like, I guess. I don't know. I'll find out the answer. Anyway.
Please do.
Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Also check us out on YouTube as well. We are following the conversation between President Trump and the Saudis in Saudi Arabia right now, and any deals that wind up coming through. And the background, though, are oil prices. You're looking at WTI just under $63 a barrel, down about 12% on a year-to-date basis. Sam Dagger is Bloomberg's senior Middle East reporter and joins us now. Sam, give us a sense of how these lower oil prices have played in the background of these talks.
Hi, I think it's crucial. I mean, you have Trump just announcing that Saudi Arabia is going to invest $600 billion in the U.S., but we don't have much details. I mean, he signed a strategic partnership agreement, but it's quite vague. It says, we're going to have more cooperation in defense, energy, and other fields, and mining, but we don't have much details. And the fact is that, we have a story today by my colleagues, Matthew Martin and Zainab Fattah, about how, Saudi Arabia actually needs $2 trillion to fulfill, its own, Vision 2030 projects, its plan to diversify its economy away from oil. I mean, that's how much money it needs domestically. And with falling oil prices, that's not going to happen under current circumstances.
What is the status of OPEC Plus these days, Sam? I mean, is Saudi still in the driver's seat there?
Yeah, I mean, it and Russia, I mean, it's not something I'm following quite closely, but I mean, I do have a story that came out yesterday about how, Saudi Arabia orchestrated this last round of, production cuts,
right,
in order to hit two birds with one stone, so to speak. One is to punish the cheaters in OPEC Plus, and the other is to actually please Donald Trump ahead of this visit, because he's been calling for lower oil prices.
Yes, he has. So it's sort of like a joint effort. On the one hand, you get the Saudis get to punish the cheaters, and then also get to help President Trump.
Exactly.
Which brings the question: what does Saudi Arabia want out of President Trump?
I think they want us to look beyond the deals, because they're saying this is about like really redefining this strategic U.S.-Saudi relationship. I mean, you have to remember this relationship started sometime in 1945 when MBS's grandfather, King Abdulaziz, met then President Franklin Delano Roosevelt on the USS Quincy. And the agreement back then was pretty simple. I mean, in return for U.S. security and defense guarantees, Saudi Arabia supplied cheap energy. But obviously, we are now living in a completely different world, and the circumstances are changing. And Saudi Arabia, as I said, has this MBS has this huge, ambitious project to basically overhaul the economy and reduce its reliance on oil. And in order to do that, he needs foreign direct investment. And a cornerstone of that is, the involvement of U.S. companies, U.S. investors. That hasn't happened yet. And the Saudis are hoping that, this visit will basically usher in sort of a new era of cooperation between the U.S. and Saudi Arabia. So they're looking at it more like, the big picture, the future, versus Trump, who's looking at it more as, deals and announcements that he's going to be able to make in Saudi Arabia.
Sam, with President Trump meeting in such a high-profile fashion with Mohammed bin Salman, MBS, does that suggest that MBS is now, I guess, welcomed back onto the world stage?
Yeah, absolutely. I mean, this is, the whole world, and particularly Western, nations who, if you remember in 2018, when he was accused of ordering the killing of Washington, Post columnist Jamal Khashoggi at the Saudi consulate in Istanbul. I mean, obviously, the Saudi version is that he had nothing to do with it. It was something that his underlings undertook, and he had no involvement whatsoever. But the whole world has, particularly Western countries, have looked beyond that because they feel like it's too costly to overlook Saudi Arabia. First, as a source of contracts, of business, this is a country that's in the heart of the Middle East in terms of they're in terms of you can't do anything in the Middle East without Saudi Arabia. That's really it. So they had to look beyond that, and obviously with Saudi Arabia this is before the current situation with oil prices. Saudi Arabia was the main source of capital and also contracts for a lot of Western companies. So obviously everybody's looked beyond that. I mean, today MBS greeted Donald Trump as if he were the king of Saudi Arabia, except for the title. I mean, all the pomp and circumstance were that of a king greeting a head of state.
Sam, thanks so much for joining us. Sam Dagger, senior Middle East reporter for Bloomberg News, joining us via Zoom from Dubai. Again, at the beginning of President Trump's trip to the Middle East, a number of economic deals announced by the Trump administration.
And what's interesting is that Saudis produce oil on the cheap, but because of their Saudi Vision Plan of 2030, where they have to pump a lot of money into transforming its economy, they really need oil prices near $100. We're talking like 90, 95 to make that happen. So to sacrifice that revenue in order to gain other things, those other things have to be very worthwhile to sort of make up that revenue.
So they can't, the fact is they can't, the oil is what it is, and there's only so much they can do to impact the price.
No, there's a lot they can do. They're just willing to take a hit on that fiscal revenue side in order to gain either compliance or maybe favor with President Trump, but they're willing to take it, but it hurts. All right, coming up, George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Analyst, talking about China finally removing a ban on Boeing deliveries. This is after the U.S. trade truce. We'll break down what exactly that means for the two largest trading partners. You're listening to Bloomberg Intelligence. Happy Tuesday.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan, streaming live on YouTube. Head over to youtube.com and search Bloomberg Live Podcast. That's where you'll find us. I'm looking at the shares of Boeing. BA is the ticker. Stock's up 15% year to date, up 2.5% today. That's a 52-week high for this stock. Well off its all-time high set back in late 2019, but still, this thing is showing some signs of life here. News today, China removes ban on Boeing deliveries after U.S. trade truce. Let's see what this means for our good friends at Boeing. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence, joins us here. George, it's been such an up-and-down story with Boeing, particularly as it relates to China, and I know it's such a big market here. What does this news today mean that China's removing its ban on Boeing deliveries? What does that mean for them?
So I think what it means for Boeing in the short term is that they could probably get, some of these inventory airplanes they've built. They're sitting on tarmacs. They're maintaining them, cost Boeing a lot of money. They can get them delivered into China. Cerium expects 34 of those airplanes to go in through the remainder of the year. Then get them delivered into China, get them off their books, sort of get rid of that extra expense it costs for them to manage those airplanes, so they can just get on to focusing on the factory floor and building brand new airplanes. So I think it's a positive. We'll see how long it lasts, but it's definitely a positive.
Was this sort of baked into the U.S.-China trade talks, or was this irrespective? Do you have an idea?
No, I'm not sure what's baked into the U.S.-China talks. We have a report out today, though. I do think that there's an opportunity here for Boeing to get to even new orders from China. We haven't really seen material orders out of China since 2018, so last decade before the pandemic. Relations have been a bit strained since then. I think it's one more piece of evidence that shows, look, as the U.S. and China get into negotiations over trade, you're going to see heavy fracturing, and then we see the markets kind of get very distressed about that. But behind the scenes, there's discussions about putting that relationship back together, and Boeing probably factors in high in those negotiations. And so I think you could go from hey, there's despair here, to, hey, look, there's a 300 airplane order for Boeing coming out of China. So it's going to be a real up and down, I think, roller coaster here.
George, are there airplane manufacturers in China, or do they depend solely on Boeing and Airbus?
They depend largely on Boeing and Airbus. There is a manufacturer, Comac. They've been building a 737, A320, substitute. They call it the Comac C919. The airplane's rolling out slowly. I think we saw 15 or 20 deliveries last year. This is a country that probably needs at least 150 narrow bodies a year, so not going to fulfill all their needs. There's about that many flying right now, and when we look at the flying statistics for that airplane, it's not flying as frequently as A320s and 737s, so it seems to us that the maturity of that product isn't there yet for the Chinese to substitute out all of the Western jets.
Right. So there's still a little bit of a way to go. You also have to wonder, just in general, the comeback that Boeing has been able to make. George, how would you describe the situation that Boeing is in now versus a couple years ago?
Yeah, I think this year is what we expected last year to be before the door came off the door plug in the Alaska jet. We're starting to see good flow through the factory in the delivery numbers we've seen. We're starting to see them deliver that inventory of built airplanes, like I said, that drag on costs pretty heavily. We're hearing good things about supply chain. They're going to pull Spirit Aerosystems into Boeing by mid-year. That was a big part of their problems. I think pulling them in helps them control quality at Spirit. So I think this story this year should be all about improving quality, improving throughput in the factory, in the back half, some good cash generation. So I think this year is what everybody thought last year would be, which could be a pretty good year.
So where are you, George, in your model in terms of 737 kind of build rate here? Because I know that just, with the economic model for Boeing, that just drives cash flow, the more planes they can get through the line.
We're looking for like a 45 to 50% increase in 737 deliveries this year. So a really heady increase. And again, that's going to be the big driver of cash generation for the company over the year. And probably the exit the year, a build rate per month of 38, we think even maybe into the 40s kind of build rate, which is an area where they should be able to generate some profits.
All right, George, thanks a lot. Super appreciate it. George Ferguson, he heads up all of our coverage for Bloomberg Intelligence for aerospace, defense, and airlines as well. Okay, if you were closely watching Mark Carney's cabinet in Canada, we got info for you. The Canadian Prime Minister Mark Carney unveiling his new economic team, including Francois-Philippe Champagne as the finance minister, Timothy Hodgson as energy and mining minister. The team's going to focus on carrying out Carney's ambitious economic agenda, like negotiating a long-term solution to the trade conflict with the U.S., boosting the domestic economy, and creating stronger ties with trading partners in Europe as well as Asia. Did you have any bets on that?
Did you take French in high school?
I did.
Nice.
But I also worked in a French restaurant for 10 years and still can't speak a lick of it, so score.
That was good. I'm giving you credit for that. Because I was not going to read that headline, despite Mark's
you were not going to do it?
I was not going to do it.
Okay, but his name could also be Champagne, and I just said Champagne.
That's where I was going.
Yeah, but I could also be very wrong at the same time. Okay, so for our listeners in the U.S. and for more French, a reminder, you can listen to us via satellite radio, Sirius XM Channel 121, access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now on a day where the market is very close to erasing all its losses for the year for the S&P.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great second hour lined up for you. First of all, we're going to be monitoring the Saudi-U.S. Investment Forum being held in Saudi Arabia. President Trump will be speaking there. We'll bring that to you when he begins. In the meantime, we're going to have the markets covered for you as you're looking at an S&P almost erasing all the declines for the year. Then Glenn Losseff is Bloomberg Intelligence Senior Equity Analyst on United Health. It's the worst performer within the Dow, leading to the Dow relative underperformance. Also, Erica York, Vice President of Federal Tax Policy, the Tax Foundation, will join us on President Trump's tax bill, or I guess I should say the GOP tax bill that we got out yesterday. Plus, Michael McKee will break down CPI and what we learned as we push ahead to PPI and retail sales on Thursday. And finally, Sean O'Hara is president of Pacer ETFs to talk about ETF investing in current flows. The action the last couple of days has been incredibly whippy, changing really far, really fast. So we'll see what the flows are actually telling us. But let's kick it all off for you right now with the Bloomberg Business Flash. And for that, we go to Charlie Powell.
Hi, thank you very much, Alex Steele. Here's what's going on. Stocks ripping higher again, at least for the NASDAQ Composite Index. We got a rally in the world's largest tech companies, wiping out the stock market's losses for the year. Now, right now, NASDAQ is up 1.4% on the day, higher by 270 points. Key takeaway for the S&P 500 index, it is now up 0.7%. But you check the year-to-date column on the Bloomberg, the S&P 500 index now higher on the year by 0.1%. The Dow, as Alex mentioned, is lower, down 181 right now, down 0.4%. United Healthcare plunging 16.3%. More on UNH coming up in just a moment. Your 10-year 4.46% with a 2-year currently yielding 3.98%. Gold up 0.3%, 32.44 the ounce, and West Texas Intermediate crude 63 even a barrel. WTI up right now by 1.7%. Bottom line here, an update for the S&P and NASDAQ, also the NASDAQ 100 index. Callie Cox is chief market strategist at Ritholtz Wealth Management, and on surveillance this morning, she offered up this advice for investors.
When the S&P is down 10%, 5 to 10% from its highs, it's usually a good buying opportunity if you have the patience. But look, we also understand that we're serving humans here and we all have emotions. So I don't think raising cash here is a problem on the margins, especially because you're getting good savings rates. But I think you have to really stick to a plan here because this isn't a market you can necessarily gut check.
Callie Cox of Ritholtz Wealth Management. So again, S&P 500 index is advancing. The S&P up right now by 0.7%. And a story we're monitoring, the Trump administration is preparing to announce a deal that would grant Saudi Arabia more access to advanced semiconductors, advanced micro devices up now by 3.5%. NVIDIA shares up now by about 5.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele alongside Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Head over to youtube.com and search Bloomberg Live Podcast. That's where you'll find us. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Alex Steele, and we're joined by Bloomberg's Isabel Lee. Isabel, what are you looking at?
I'm looking at Coinbase. We have shares edging higher by as much as 17%. So they're finally going to be added to the S&P 500 next week. I say finally because I covered the quarterly rebalance and I've written around 3 templates for them because we've been hearing industry chatter for a while. And really, this is a milestone for the industry. A lot of people are saying this is a sign of times. It's really indicative of the broader acceptance. We have Michael Saylor to Cassie Wood congratulating Coinbase CEO Brian Armstrong. And Armstrong, for his part, made it a point on Twitter to say that crypto will now be in everyone's 401k because, of course, if you buy the S&P, then there's that. Some would argue, though, that there's already Tesla, which arguably is also, it has a large Bitcoin holding. But still, so this is good for the stock. And we have Melissa Roberts of Stephens estimating that passive funds will need to purchase 35 million coin shares in about 4 days. So we'll see some buying demand there. And of course, there's the index effect, whether or not you believe in that. But the stock may pop.
I mean, index effect for real. I mean, that's definitely something. It just depends on how long and sustainable that pop is. What else are you looking at?
On. So this is kind of a cult favorite. It depends on your flavor of shoe. You said you like shoes, Paul, but I don't know if you like On. It's raising its sales growth forecast to at least 28% for 2025. And that's really on the back of strong demand despite economic uncertainty. So the company, founded in 2010, is backed by Roger Federer, arguably one of the best tennis players of all time. And it's become one of the really top-performing sneakers in the world. It expanded from core running shoes to areas like tennis, training, and apparel. And we have Wall Street cheering the results. Stifel called the results impressive. Truist said revenue handily beat consensus. But like many others, it also added a lower end to its profitability forecast. But yes, On. In fact, I own a pair of Ons, and I bought it in France because in the New York stores, there's always a line outside.
Is it really?
And I'm just never going to line up for shoes. Yeah,
I don't understand anyone who lines up on lines.
Exactly.
To get into a
for
store.
Shoes.
For shoes.
Yeah.
Yeah. Interesting. All right. What else you got?
Rigetti, so this is seeing the opposite direction. Stock is down as much as 10%. So they tumbled after missing revenue expectations. Operating loss was also larger than forecast. It did report profit, but that's really owing to an accounting gain. So the CEO said revenue can be, quote, lumpy, since quantum computing continues to be in research and development mode. So think of quantum computing, and I'm going to try my best, as basically computing, but super fast, because instead of computing sequentially, it does it parallel-wise.
She's looking at us as if like we know the answer to that.
Yeah, right? Please affirm me. But, so the company notched a handful of contracts this year, though, from the U.S. and the UK. But for now, it's not looking good for the stock.
All right, thanks a lot. We really appreciate it. Isabel Lee joining us from Bloomberg. For more conversations just like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. All right, well, let's get to one of the most underperforming stocks within the market today, dragging on the Dow Jones Industrial Average. Now, I know many people don't look at it, but nonetheless, it's a pretty chunky move, so it's worth discussing, and that's United Health. Glenn Lusef is Bloomberg Intelligence Senior Equity Analyst, joins us now. So, suspending the 2025 outlook, naming a new CEO, what was the biggest surprise here?
So the biggest surprise was suspending the 2025 guidance, and this comes after the company lowered 2025 outlook just about 3 weeks ago when the company reported first quarter results.
So what's the problem with this business? I thought the healthcare insurance business is just rips it.
Well, it all goes in cycles, right? It is surprising that United is having these problems, basically that began in at the start of 2024, if you remember, there was a Change Healthcare attack, and after that, it just seems that United management was trying to fix things while other things fell apart, and has been on the back foot. And that's probably one of the reasons that the CEO that led the company since 2021, I believe, left the company, and the chairman and the former CEO is taking the reins to sort of reposition United for, next phase of growth.
So, right. Well, where is that growth going to come from? Because there are higher than expected medical costs, right, and some reimbursement struggles. Can you walk us through what we learned about that?
Yes, basically, the company cited that the medical cost trend among new members in its Medicare portfolio is accelerating relative to the first quarter trends, which was higher than expected already. Basically, if it continues, the company can always sort of try to get more premium per member from the government as it deals with Medicare to reset the margin expectations or normalize the margins. That being said, if the medical costs continue to accelerate, and specifically with with everything that's going on in Washington, right, with the sort of funding overhang and all that, it may become a problem over the longer term. But at the same time, managed care companies can always exit underperforming markets. It just may take a little bit longer than sort of investors would like to see.
Gotcha, Glenn. Thanks so much for getting us up to date there, Glenn Losov, Bloomberg Intelligence senior equity analyst, talking about United Health Group. They're naming a new CEO. They suspend their 2025 outlook. Stock trading off pretty substantially here, more than 10%. Another stock in the news, Microsoft says it's cutting 3% of its employees to reduce management layers. I'm looking at the stock here. It's pretty much unchanged on the day. It's up 6% year to date. But anytime Microsoft does anything, we want to get to the bottom of it. Anurag Rana, he does that for us. He's Bloomberg Intelligence senior technology analyst. Anurag, is this just kind of annual culling of the ranks, or is this saying something different about Microsoft and maybe where it sees its future?
I think it's a little bit of both because, in the numbers, 3% does not say much. But at the same time, Microsoft is not hiring at the same pace that it used to. And I think one of the areas where it is deploying AI is coding or, R&D. That's an area where we anticipate productivity to improve because of the tools we have and not anticipating headcount to grow up. Second thing, Microsoft is investing very heavily in AI right now. The CapEx is going to be extremely high, as north of $80 billion for the next 12 months. And, that they have to offset some of that pressure on gross margins with cuts on the operating expense side so that the net operating margin doesn't get impacted. So I think it's a little bit of all the above.
Was this a surprise?
Not really. I mean, 3% to me does not come as a surprise. 3% is, in an environment like right now where companies are not anticipating the real attrition rate. So on a normalized basis, if a company is seeing employee attrition between 10 to 15%, we're not seeing that right now. So the company has to do something in order to get back to the normal range of their financial planning. So as I said, this doesn't sound too much to me, but there could be a little bit more based on, who they are trying to get rid of. If it's higher on the paychecks, then I think it has to do with, protecting your margins.
Right now, as we speak, we see President Trump entering the Saudi U.S. investment conference. And if he has comments, we will bring them to you directly. Anurag, talk to us about just what the investment thesis is regarding Microsoft right now, given some of the tariff uncertainty, given some of the geopolitics uncertainty. What's the call on Microsoft these days?
For the last few years, we have been saying this is probably one of the cleanest stories in AI and software land because it doesn't get impacted with tariffs. There is some marginal secondary impact because of, if we do get into an economic slowdown. But the real benefit for them is they are hosting ChatGPT, the most favorite app of consumers right now, and they get the benefit of that. So if you have, let's say, your user base goes from 200 million users to 300 to 400, now we are close to about 500 million users. it really helps Microsoft because they are hosting that app. And as those users use ChatGPT for a longer period of time, they get to make more money. So I think that's really one of the bigger benefits where they are offsetting the risk that we are seeing that other software vendors are seeing because of the lack of headcount growth across the tech landscape.
So based on that, do we think that we're going to see other tech companies follow suit in this particular way? Like if Microsoft is a creme de la creme, as you see it, who's next?
So, Alex, when you look at it, as I said, 3% does not scare me as much. But if over the next 6 months we start companies come out and say, well, I'm laying off like 7 to 10% of my workforce, that is concerning because that's concerning for two reasons. One, these companies do buy software from other companies such as a Workday or a Salesforce because these two companies are seeing some pressure on their seat growth because their end customers are not hiring as much. So lack of hiring is a concern not just for the companies or the industry themselves, but for the software landscape as well, because primarily this is a seat-based monetization model.
Anurag, before we got all enmeshed in tariffs over the last few months, we seemingly talk to you every day about the AI story. That's kind of fallen off the radar screen a little bit here for, I think, Global Wall Street. Not for you guys. What is the AI story today? What's the feeling in the marketplace about AI as a growth story for tech?
Yeah, one of the things DeepSeek did for the entire space was divided the space in two different buckets. One was the AI infrastructure play, and the other one is more on the application side of it. And Microsoft, I think, guided them a little bit towards that framework because when you look at it, Microsoft is really focused on the inferencing side of it, which is hosting the applications. Things that are more on the infrastructure side, whether it's the chip building from NVIDIA or a recent IPO like CoreWeave, they have not done as well as some of the other vendors because people are wondering, why do I need to play the infrastructure game? Because it's CapEx heavy and we do not know how things are going to shape up in the next 2 to 3 years. One thing is sort of certain that even after 3 years, the number of use cases on AI is going to rise. So you want to be on the application or the inference side of things rather than the infrastructure side of things.
Right, and that's going to be a lot more profitable going forward, but it also requires something very different at the end of the day, right? You're going to have basically locations that are closer to the actual use point, right? So closer to where I am and where you are versus out in the middle of nowhere, but you have a huge heavy load. How does that change either investment or power usage, et cetera?
That's probably one of the most important questions out there right now. So somebody like a Microsoft is saying, for my training needs, I will go to those data centers that are out in the boondocks and middle of nowhere, and that could be my data center, or I could lease it from somebody like a CoreWeave. But for the application side, I'm going to create or lease smaller data centers that are well connected, where I'm going to do the inferencing or from the user point of view.
All right, Anurag Rana, thank you so much. We appreciate that. Anurag Rana covers all the technology stuff for Bloomberg Intelligence, getting the latest on Microsoft, laying off 3% of their workforce. It's not pretty much unchanged on the news here, where we were waiting. President Trump, he's going to make some comments from Saudi Arabia at the U.S.-Saudi Economic Conference. We will bring those comments to you when he does speak. And in interim, let's get a little check on the marketplace with Charlie Pellet of Bloomberg Business Flash.
Hi, thank you very much. And here's what's going on. We've got the S&P 500 index higher and wiping out its loss for the year in the year-to-date column, looking at a gain of 0.1%. Do want to begin with a key headline, though. Important development out of the Middle East at this hour. President Trump will briefly meet Syria's new leader, Ahmed al-Sharaa, in Saudi Arabia tomorrow. This, according to a White House official, this encounter will be a significant boon for al-Sharaa, whose group toppled Bashar al-Assad's regime in December. S&P, as I mentioned, higher by 0.8%, taking out the year-to-date loss, showing a gain for the year of 0.1%. The S&P right now up 44. The Dow lower by 167, down by 0.4%, being weighed down by United Healthcare. Shares of UNH down now by 15.9%. NASDAQ up 274, gain there of 1.5%. The 10-year yield, 4.47%. The 2-year, 3.99%. Spot gold up 0.3%, 32.44 the ounce. And West Texas Intermediate crude now at 63.05 a barrel, up by 1.8%. Coinbase Global, the largest American cryptocurrency exchange, will be added to the S&P 500 in the latest milestone for the booming digital asset industry. Coinbase now is surging. Coinbase up by 18.2%. Recapping, S&P up 0.7%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks a lot. Really appreciate it. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. And just for an update, we are waiting for President Donald Trump to speak at the U.S.-Saudi Investment Forum. Remember, this is his first scheduled overseas trip since taking office, aside from going to the Pope's funeral. Now, already the U.S. has said that Trump has secured $600 billion in investment commitments with agreements to boost defense and technology ties. He is due to speak in just moments. The forum is being held alongside Crown Prince Mohammed bin Salman, who will also be giving an address. In the meantime, let's talk about the economic data that came out, that CPI, that was actually a little lower than estimated. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now. So does that mean, like, hey, there's no inflation, we're all good now?
Yeah, we can all go home.
Cool. Okay, thanks for the hit. You can go home now.
I'm going to go home now and go to bed. Right now, it does appear that inflation, shall we say, if we were looking at an economy without Donald Trump in it, the economy would be performing as it was at the end of last year, with inflation continuing to fall and growth at a reasonable pace. What we're looking for is any sign that Trump has interrupted that. And we know that with GDP contracting in the first quarter, while that was kind of technical with imports, that wouldn't have happened if he hadn't put on the tariff stuff. So did we see it in CPI? Not really, not yet. There are some areas, electronics went up, but not in the overall numbers. Some of the other things you'd think would have gone up if tariffs had been in place would be things like apparel, the automobile industry. Now, auto parts did go up some, so maybe we can see the beginnings of it in that. But it's probably going to be a couple of months. The folks at Politico coined the phrase this morning. This is the not yet administration. It's supposed to slow growth, but not yet. It's supposed to bring inflation, but not yet. And you can see this playing out today. Trump's supposed to speak, but not yet.
Yep.
So I'm here.
Exactly. So are we, I guess if you're the Fed, you're keeping an eye on inflation, you're keeping an eye on the labor market. Does one get preference over the other these days at the Fed, do you think?
The Fed is going to be watching to see how fast inflation might go up, because we have the questions about what inflation expectations are. We get a new University of Michigan survey on Friday, and if we get some indication of inflation problems, that would worry them. But unemployment, they think, would probably move relatively slowly. The question is, which one gets farther from where they're supposed to be? And that's the one that they would try to deal with first.
Looking ahead, so we don't get anything out really tomorrow, right? We're going to be looking ahead to Thursday, PPI and retail sales.
Yes.
The risk that PPI will actually be a lot
PPI
higher.
is going to be more interesting because that'll pick up things like intermediate manufacturing goods, and we'll see if prices went up. Again, might be too early for directly tacking on the tariffs, but companies might have raised prices in advance because they were pulling in all of these imports. And also shipping costs may have gone up because of the import surge. So it's possible in this case that we see it in PPI. We also want to see in retail sales, are people still spending money?
Or did they front load it?
Did Alex go out and buy new shoes or something like that?
But I did buy a rug. I did buy a side table. But I wanted to front load that just in case.
Yeah, well, that's a good
And
plan.
I bought an automobile, or at least an automobile.
Right, exactly.
You win.
Yes. All right, let's just reset a little bit here. President Trump and Crown Prince Mohammed bin Salman, they are at this U.S. Saudi investment forum, and they're going to be speaking in just moments. When they do, we will bring that to you. So I guess, Mike, I'm not sure where we are with tariffs. I guess they're lower than they were a couple of days ago, but they're still out there. They're still higher than they were a few months ago. Are we going to have a recession because of that? Or now that we've dialed it back, I mean, what's global Wall Street saying?
I wish I knew. Yes, we're certainly higher than we were at the beginning of April and lower than we were 2 days ago. Where does that leave us? We don't really know because the president hasn't finalized anything yet.
Like the ships coming, I'm going to ask Gene Soroka, because I think his office at the port of L.A., he's got a window that looks across the Pacific. He can see them coming over the horizon.
Well, he can't see any right now.
That's my question. Are they coming or are they turned around?
They're not coming because of the tariffs that were put on earlier and even the ones that were postponed. Basically, people stopped buying anything from China. And so we're going to have a couple of weeks where the ships are coming in empty. The question is, will yesterday's deal lead companies to try to squeeze in whatever shipments they can in these 90 days? And there are some anecdotal reports that especially smaller companies that rely on China can't move their supply lines are desperately trying to get stuff out the door from the Chinese factories to them. So we might see a surge in imports as people try to make up for this fallow period.
We are also awaiting, of course, President Trump to speak and take the stage at the Saudi-U.S. Investment Forum. He's been walking over there with Mohammed bin Salman. He is currently sitting down. We will bring you his conversation as soon as it begins. Mike, are we looking at a possibility, though, that the ships are just offshore and when something happens, they'll just come into the dock and stuff will come off and we'll be fine?
No, that's not the way it works. The companies have to pay when they charter the ships, and if they're not bringing anything in, they wouldn't have chartered. They have hired trucks in China to move stuff to the ships from the factories, etc.
So the backlog is longer.
All that, there's no backlog right now. There will be a backlog if everybody is trying to order at once in this 90-day period, because as soon as the tariffs might go back on, then the ships are going to stop again. So we'll have to wait and see what happens over these 3 months.
Is the Federal Reserve just like us? They're just kind of looking at the data, kind of waiting. They don't want to get ahead of their skis. Or I mean, if I'm the Fed, I don't need to be a rock star here. I can just wait, right?
Right. Inflation's going down. The economy seems to be growing okay. We'll see what happens with retail sales on Thursday. But right now, the nowcasts are putting it at 1.5% to 2%, which is kind of where we were at the beginning of the year and what people expected without tariffs. So there's nothing for them to really do at this point except wait and see what happens. If they knew what the president was planning, you could stick it in the models and try to come up with a forecast. But since it changes every day.
Well, we're going to get retail sales this week, and that's a big one. I mean, how's the consumer doing out there? I mean, that's going to be really, I would think, really important.
Well, we saw a lot of prices that did not go up as expected in the goods area, so that's probably good news for retail sales, because if people were buying goods, they might have been encouraged by the fact that prices were still restrained, and they might be front-running as front-loading, as Alex said. So the odds are we could see a decent number on Thursday. The question is what happens with services, which don't show up in this report. We're looking at an overall flat retail sales number, but that's because we're not sure what autos did. Autos sales are strong, but they don't translate directly into retail sales because retail sales are done on a dollar basis and auto sales are done on a unit basis, and the GDP uses units.
Did I tell you I bought a hybrid?
Yeah.
You keep saying bought. You leased it.
I leased. That's right. I leased.
Yes,
There's a minor difference, right?
He's saving.
But I'm moving towards that green stuff.
Yeah.
See?
Well, of course, you're getting. I mean, don't let the president know.
Well, I don't know. Well,
because it's economic. I mean, that's the point.
Well, my son's he's in California at school, so the cost of gasoline out there is prohibitive. So that was the pitch to me.
I was just there, $6 a gallon.
Yes, so that was the pitch that he made to me.
That's what happens when refiners close up because things don't work out, which is part of the reason why Mike and I are doing this amazing piece together where we talk about low oil prices. Does it translate into gasoline prices? That's why I'm going to the refiner.
You're going
in
to
the
a
South.
refinery?
Yes. And Mike's going to go to
Real
Dallas.
like
a real one. Oh, yeah.
She's
on the ground reporting,
she's a
man.
very exciting. She has an exciting life. You're jealous.
I go to Disneyland and you know, Alex goes to refineries.
Yeah, although it's supposed to be really, really hot. That's another story. Okay, we are currently waiting for President Donald Trump of the United States and the Crown Prince Mohammed bin Salman of Saudi Arabia at the Saudi-U.S. Investment Forum. They will be speaking. We will take that to you as it comes. It looked like there was just a family photo of President Trump and MBS with all the executives and officials that are also there at the forum. We will continue to monitor that and dip in as they continue to speak. Mike, back on the CPI for a second, plus demand. Things like hotels and airlines and stuff, those prices fell. Is that a demand weakness signal?
Yeah, it appears to be. We were seeing prices go up. No, that's not good, and that's sort of the other side of the Trump issue is people don't want to come to the United States anymore. We've seen that reported all over the place, and airlines, et cetera, are reporting much lower occupancy. So it makes sense that prices would go down for those things because there's extra capacity.
So, I mean, we had a guest come in from Canada. They said the plane was pretty empty. So we'll have to see how that plays.
Yeah.
So anyway, we'll see. But anyway, we'll see on the tourism. But again, CPI, ex-food and energy, up 2.8% on an annualized basis. That seems fine to me. But again, Mike, you're saying the Fed needs that to go a little bit lower, right?
Well, 2.3% for the headline. And the Fed looks at headline PCE, which runs a couple of basis points below CPI. So this we'll see once we get PPI and all the nerds can start calculating what PCE is going to be, but it does look like we're getting very, very close to the Fed's target of 2%. And then, like we said earlier, they can all go home and take a nap.
Yes.
Right. No, I'm all for napping. I feel like really good for that. All right, Mike, thanks a lot. Super appreciate it. Michael McKee, Bloomberg International Economics and Policy Correspondent. All right, let's get you caught up on what's happening in the world of business. For that, we go to Charlie Pellet.
Hi, thank you very much, and here's what's going on. We've got the Dow Jones Industrial Average trading lower. United Healthcare shares certainly weighing on the Dow. Right now, UNH, that stock is plunging. We've got United Healthcare down by 16.1%, but the key takeaway at this hour, S&P, yes, in the green, yes, up by 0.9%, but a big yes, positive on the year, up by 0.2% in the YTD column on the Bloomberg. NASDAQ up 295. Tech shares ripping higher right now, up 1.6%. The NASDAQ 100 index up 1.6%. The Russell 2000 index of small cap shares gaining now by 0.6%. The Bloomberg Mag 7 index up by 1.8%. Again, keeping it all in context, the S&P up 0.8%, and once again positive on the year. The 10-year 4.47%. With a 2-year 4.00% on your 2-year. Spot gold up 0.4%, 32.48 the ounce, and West Texas Intermediate crude now rallying 2.2%, 63.33 a barrel. Hertz Global shares plunging after the car rental company posted a larger than expected loss in the first quarter, pressure by a slowdown in customer bookings. HTZ on the ticker, and the stock right now is down by 13.7%. If you are flying, specifically United, be on the lookout for this. United debuting a new interior for its incoming fleet of Boeing 787-9 aircraft, featuring 8 studio suites with doors and 27-inch seatback screens, plus upgrades throughout the rest of the cabin. Again, recapping here, stocks trading higher with the S&P up by about 0.8%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We're waiting comments from President Trump from Saudi Arabia at the U.S. Saudi Investment Forum. Mohammed bin Salman is speaking as right now. And in just moments, we'll get comments from President Trump. So it'll be interesting to see. There's a lot of deals. I think President Trump went over there looking for a lot of deals. The number I see reported is $600 billion of deals announced during this trip to Saudi Arabia. That seems like a big number to me. I know President Trump was thinking about it could be as high as $1 billion, but we'll see how it plays out. So, but again, that's what I believe this trip was about.
I think he was also hoping for $1 trillion.
$1 trillion,
Yeah,
yes,
let's ramp that up. It looks like President Trump is eventually making his way to the stage. We'll bring you his comments as he begins. Some excerpts from his speech have been released, such as he's going to offer Iran a new path towards a hopeful future. He's also going to mark some new chapters with Lebanon and Syria in his speech. In Syria, he says, we must all hope a new government will succeed. Again, he's going to briefly meet with Syria's new leader on Wednesday. This is according to a White House official. We just had Mohammed bin Salman, the Crown Prince, speak at the Saudi-U.S. Investment Forum. We're waiting for President Trump to speak as well. And to your point, Paul, $600 billion in investment commitments to boost defense and technology ties. But as you mentioned, Trump was floating, could be as much as $1 trillion.
Yeah, it's interesting. And the investment commitments, they include deals with companies such as Boeing, Alphabet's Google, Oracle, and Uber, as well as plans for artificial intelligence data centers and energy infrastructure in the U.S. So some wide-ranging deals being announced from Saudi Arabia.
The other thing to think of in the context of all of this is what we're seeing within the market as well.
Yeah.
So just to recap here, the NASDAQ is up by about 1.5%. The S&P is up by about 0.8%. Saudi Arabia is saying to work on boosting U.S. investments too. $1 trillion. So maybe we will get some kind of announcement that President Trump was forecasting. The Dow Jones down by about 0.3%. If we take a look at what's happening within the bond market, a little bit mixed. You had that better than expected CPI, but you have the long end of the bond market selling up just a touch. The 10-year yield is up by about 1 to 2 basis points, pretty much flat on the 2-year there.
Yeah, and we've got on the commodity space, oil. Moving a little bit higher here. We've got WTI crude oil up 2.25%. It's $1.38. Now we're at $63.30. We were trading below 60. And as I watch Landman, I know they want oil between, $75, $80, $85 a barrel. That's kind of the sweet spot. So again, oil lower than they would probably prefer. And on the crypto front, just for Tom Keene, I know he's listening on the Upper East Side. It's up about almost 1%. 103,500 right now. So it's a big move higher in crypto as well as a risk on asset. Let's go right now to Saudi Arabia. President Donald Trump speaking at the Saudi U.S. Investment Conference.
Great people. I want to thank His Royal Highness, the Crown Prince, for that incredible introduction. He's an incredible man. Known him a long time now. There's nobody like him. Thank you very much. Appreciate it very much, my friend. And it's a tremendous honor to return to this beautiful kingdom and be welcomed back with such extraordinary generosity and warmth. I've never forgotten the exceptional hospitality showed to us by King Solomon, who's just, we talk about a great man. That is a great man. That is a great man, a great family. Now, that visit took place exactly 8 years ago. The graciousness of the royal family and the Saudi people is really unsurpassed, no matter where you go. Let me also thank the countless ministers, government officials, business leaders, and distinguished guests for that warm welcome. Very warm, and I know so many of you. I'd like to call out all of your names, but we have a lot of problems. We'd be here for a long time. We don't want that, so don't be upset. With this historic state visit, we celebrate more than 80 years of close partnership between the United States and the Kingdom of Saudi Arabia. Ever since President Franklin Roosevelt met with King Solomon's father, King Abdul Aziz, aboard the USS Quincy in 1945, the U.S.-Saudi relationship has been a bedrock of security and prosperity. Today, we reaffirm this important bond, and we take the next steps to make our relationship closer, stronger, and more powerful than ever before. It is more powerful than ever before. And by the way, it will remain that way. We don't go in and out like other people. It will remain that way. I've come this afternoon to talk about the bright future of the Middle East, but first let me begin by sharing the abundance of good news from a place called America. In less than 4 months, our new administration has achieved more than most other administrations accomplish in 4 years or even 8 years. We've actually done, for the most part, more. The day I took office, we inherited, thank you. Thank you. The day I took office, we inherited a colossal invasion on our southern border, an invasion like you'd never want to see here. Nobody should ever want to see it. But within weeks, we slashed illegal border crossings to an all-time low, down 99.999%. That's good, even for this great gentleman standing right in front of me. That's a good number. We had hundreds of thousands of people. They came in at the same time last year, and last month we had, in this massive border, 3 people that got in. That's quite a difference, and we have no choice but to get a lot of the people that came in because they were not the best people. They were, in many cases, very bad people. We're getting them out. We're getting them out very fast. We're bringing them back to where they came from. We have no choice. After years of military recruiting shortfalls, enlistments in the U.S. Armed Forces are now the highest in 30 years because there is such an incredible spirit in the United States of America. We have tremendous spirit again. Just about a year ago, it was a big story, front page on every paper all over the world, that nobody wanted to enlist in our military, meaning we were way under enlisted. And just last week it came out that we had the strongest enlistment. They say 30 years, but probably it's maybe ever. They don't go back that far. It's the best, and that includes police officers, firemen, everything else. Is a great spirit in the United States right now. A brand new poll from Rasmussen just showed that the number of Americans who believe the nation is on the right track, they have a right track, wrong track, is now the highest in over 20 years. And it hasn't been anything like this because for many years it was the wrong track. And I can tell you for the last 4 years it was definitely the wrong track, but it's the highest it's been in many, many years. We renamed the Gulf of Mexico into the Gulf of America. That was very popular, other than perhaps with Mexico. And most importantly for the people in this room, the days of economic misery under the last administration are rapidly giving way to the greatest economy in the history of the world. We are rocking. The United States is the hottest country, with the exception of your country, I have to say, right? I'm not going to take that on. No, Mohammed, I'm not going to take that on. Wouldn't that be a terrible thing if I made that full statement? But I will not do it. You're hotter. At least as long as I'm up here, you're hotter. But groceries, gasoline, energy, and all other prices are down with no inflation. We have no inflation, and in a few short weeks, we've created 464,000 brand new jobs. Think of that. It's almost 500,000 jobs created just in a matter of weeks. We just reached a historic trade agreement with the United Kingdom, and over the weekend we reached a breakthrough agreement with China. Both outstanding deals. China's agreed. We have to get it down. We have to get the little details down. And Scott, you're going to work on that very hard, but China's agreed to open up to the United States for trade and everything else. But they have to do it, so we'll see what happens. But we had a very, very good meeting with both of those countries. We are cutting 10 old regulations for every new regulation. We're getting rid of all of the red tape that is so many, frankly, countries, as they get older, they develop a lot of red tape, and we're getting rid of it. We're getting rid of it at record levels. And I'm pleased to report that the United States Congress is on the verge of passing the largest tax cut and regulation cut in American history. We think we're in good shape to get that. And if we get that, that will be like a rocket ship for our country. In the first quarter of the year, the Investment in America was up an astounding 22%. More than $10 trillion of new investments have been announced or are coming just since the election on November 5th. So think of that. In a very short period of time, we have over $10 trillion, and it could be much higher than that. Not everybody comes to the White House to have a news conference that they're going to be opening up in America, but they're all coming in at numbers that we've never seen before. If you take a look at other presidencies, they wouldn't do $1 trillion sometime in years. We did this in essentially 2 months because you have to say we got into office and they gave me about a month to clean up and fix up the Oval Office. And after that, we started working. And the money is pouring in, the jobs are pouring in, the companies are pouring into our country like we've never seen before. There's never been anything like it. And we let other people tariff us into losing a lot of money and a lot of jobs, and now we're tariffing them, and it's at a level that nobody's seen. It's a level that is making us a very much different country and a very different Republican Party. We won a tremendous victory in November. We won all 7 swing states, the popular vote by millions and millions of votes. The Electoral College, we won by 312 to 226. Remember, they said, well, we could get to 270. You know, we got to 312. That's a big difference. And very importantly, we won counties throughout the United States, 2,660 to 451. That's why when you look at a map, they're all red. The whole country is red. Red stands for Republican. From the moment on and from the moment we started, we've seen wealth that just poured and is pouring back into America. Apple is investing $500 billion. NVIDIA is investing, and I see my friend is here, Jensen. That's very good, wherever you may be. Thank you very much, because he's putting in $500 billion. TSMC is investing. Where is Jensen, by the way? Where is he? He's standing here. Where is he? I just saw Beth. Thank you very much, Jensen. I mean, Tim Cook isn't here, but you are. What a job you've done. He said he's got 99% of the chip market. I don't know. That's a big, that's not easy to beat. But what a job you've done. Thank you. We are proud to have you in our country. You know that. Thank you for the investment. TSMC is investing $200 billion, and with this trip, we're adding over $1 trillion more in terms of investment into our country and buying our products. And, you know, nobody makes military equipment like us. We have the best military equipment, the best missiles, the best rockets, the best everything. Best submarines, by the way. Most lethal weapon in the world. In addition to purchases of $142 billion of American-made military equipment by our great Saudi partners, the largest ever. This week, there are multi-billion-dollar commercial deals with Amazon, Oracle, AMD. They're all here. Uber, Qualcomm, Johnson & Johnson, and many, many more. So I want to congratulate everybody. So many great business executives, many of you, most of you I know. And they're coming in, you know, about a month ago. They weren't that happy when they saw me. And now they're saying, sir, you're doing a great job. Thank you very much. It's amazing what a rising market will do. Oh, it's going to get a lot higher. In fact, I told people 5 weeks ago, this is a great time to buy. I got criticized for that. Now they don't criticize me anymore. People should have listened. But it's going to go a lot higher. You see, we've never had anything like this happen. It's an explosion of investment and jobs, and great companies are coming in. Never seen anything like it. There's no better place to make a future or make a fortune, do anything, frankly, than what we have in the United States of America under a certain President, Donald J. Trump. I have the right attitude. I have the same attitude that the people in the front row, second row, third row have. As you get back, perhaps they start to wane a little bit in terms of their view. But they understand, and we're doing what a lot of smart people would do. And we're not necessarily being politically correct. You saw what we did yesterday with healthcare. We've cut our healthcare by 50 to 90%. You're going to see drugs and pharmaceuticals come down at numbers that nobody has ever seen. And drugs, pharmaceuticals, we think will be dropping. And it'll be a redistribution of costs with other nations, which really took advantage of a very nice group of people that ran our country. But not only is this a time of incredible excitement in the United States, it's also an exhilarating period right here in the Arabian Peninsula. Beautiful place, by the way, beautiful place. Exactly, thank you. Exactly 8 years ago this month, I stood in this very room and looked forward to a future in which the nations of this region would drive the forces of terrorism and extremism, drive them right out of existence, and take your place among the proudest, most prosperous, most successful nations anywhere in the world as leaders of a modern and rising Middle East. So exciting, so exciting. Mohammed, you sleep at night? How do you sleep? Huh? Just thinking. What a job. He tosses and turns like some of us. Tosses and turns all night. How do I make it even better all night? It's the ones that don't toss and turn. They're the ones that will never take you to the promised land, won't they? But you have done some job. True. But critics doubted that it was possible what you've done. But over the past 8 years, Saudi Arabia has proved the critics totally wrong. The transformation that has occurred even by these incredible business leaders. I mean, you had the biggest leaders in business anywhere in the world standing right before us. But the transformation that has occurred under the leadership of King Salman and Crown Prince Mohammed has been truly extraordinary. Such a thing has, I don't think, ever happened before. I've never seen anything at that scale happen before. And I guess, maybe you could say the United States is doing pretty well too, but I don't think too many people have seen that happen before. Majestic skyscrapers, the towers that I see, the difference between now and 8 years ago. And 8 years ago was very impressive, but the towers that I see rising, some of the exhibits that I was shown by Mohammed, what I've seen there is just an amazing, it's amazing process, amazing genius of so many people, architecture, but I have a feeling I know where many of those ideas came from. Happens to be sitting right in this room right before me, but the towers and all of the different, I've seen a lot of different towers. I didn't think there's any version of a tower that I haven't seen in one form or another. I just passed 4 exhibits. I have never seen anything like any of them. So it's going to be very exciting. And they sit among the ancient wonders of a growing and exciting city. It's really amazing. Riyadh is becoming not just a seat of government, but a major business, cultural, and high-tech capital of the entire world. The World Cup is here. Johnny, just stand up, Johnny. Johnny, thank you, Johnny. Great job, Johnny, great job. But the World Cup and the World Expo will soon be coming here, just like the World Cup is coming to the United States. It's going to be really exciting next year. The engines of Formula One racing now roar through the streets of Jeddah in a historic milestone. Other industries recently surpassed oil. Think of it, all of your other industries now have surpassed oil. I don't know if a lot of people will understand what that means. It's so big to make up a majority of the Saudi economy for the very first time ever. So think of that. Other industries are now bigger even than oil, which is always going to be a big monster. It's a big one, but that's a great tribute to you and economic development properly used. In other cities throughout the peninsula, places like Dubai and Abu Dhabi, Doha, Muscat. The transformations have been unbelievably remarkable. Before our eyes, a new generation of leaders is transcending the ancient conflicts of tired divisions of the past and forging a future where the Middle East is defined by commerce, not chaos, where it exports technology, not terrorism, and where people of different nations, religions, and creeds are building cities together, not bombing each other out of existence. We don't want that. And it's crucial for the wider world to note this great transformation has not come from Western interventionists or flying people in beautiful planes giving you lectures on how to live and how to govern your own affairs. No, the gleaming marvels of Riyadh and Abu Dhabi were not created by the so-called nation builders, neocons, or liberal nonprofits like those who spent trillions and trillions of dollars failing to develop Kabul, Baghdad, so many other cities. Instead, the birth of a modern Middle East has been brought by the people of the region themselves, the people that are right here, the people that have lived here all their lives, developing your own sovereign countries, pursuing your own unique visions and charting your own destinies in your own way. It's really incredible what you've done. In the end, the so-called nation builders wrecked far more nations than they built, and the interventionists were intervening in complex societies that they did not even understand themselves. They told you how to do it, but they had no idea how to do it themselves. Peace, prosperity, and progress ultimately came not from a radical rejection of your heritage, but rather from embracing your national traditions and embracing that same heritage that you love so dearly. And it's something only you could do. You achieved a modern miracle, the Arabian way. That's a good way. Today, the Gulf nations have shown this entire region a path towards safe and orderly societies with improving quality of life, flourishing economic growth, expanding personal freedoms, and increasing responsibilities on the world stage. After so many decades of conflict, finally it is within our grasp to reach the future that generations before us could only dream about, a land of peace, safety, harmony, opportunity, innovation, and achievement right here in the Middle East. So beautiful. It's such a beautiful thing that's happening. I guess, you know, the people that are here can't even really appreciate it because you see it happening, and it's when you come to a place that you haven't seen in 5 years or 10 years or 20 years that it's even more incredible. When I left office just over 4 years ago, that future seemed almost impossible, what you've done. Together we had obliterated the killers of ISIS. We wiped them out, terminated its founder and leader, al-Baghdadi. We had healed the divide in the Gulf Cooperation Council. It's a very big deal. And united the nations of the region to stand against the enemies of all civilization. We'd imposed unprecedented sanctions on Iran and starved the regime of resources to fund terror. They were unable to fund anything because they had no money left. They had no money. But the new administration came in and let them have a lot of money, and you saw what happened. It was not money well spent. And with the historic Abraham Accords that we're so proud of, all the momentum was aimed at peace, and it aimed very successfully. It's been an amazing thing, the Abraham Accords, and it's my fervent hope, wish, and even my dream that Saudi Arabia, a place I have such respect for, especially over the last fairly short period of time, what you've been able to do, but we'll soon be joining the Abraham Accords. I think it'll be a tremendous tribute to your country. And it will be something that's really going to be very important for the future of the Middle East. I took a risk in doing them, and they've been an absolute bonanza for the countries that have joined. The Biden administration did nothing for 4 years. We would have had it filled out. but it will be a special day in the Middle East with the whole world watching when Saudi Arabia joins us, and you'll be greatly honoring me, and you'll be greatly honoring all of those people that have fought so hard for the Middle East, and I really think it's going to be something special, but you'll do it in your own time, and that's what I want, and that's what you want, and that's the way it's going to be. When I left office, the only thing still standing between this region and its unbelievable potential was a small group of rogue actors and violent thugs seeking constantly to drag the Middle East backward and into havoc, mayhem, and indeed into war. Unfortunately, instead of confronting these destructive forces, the last U.S. administration chose to enrich them and empower them and give them billions and billions of dollars. The Biden administration, the worst administration in the history of our country, by the way, spurned our most trusted and long-standing Gulf partners, and I can say partners worldwide, one of our great, great partners, no matter who we look to, and we have great partners in the world, but we have none stronger and nobody like the gentleman that's right before me. He's your greatest representative, greatest representative. And if I didn't like him, I'd get out of here so fast. You know that, don't you? He knows me well. I do. I like him a lot. I like him too much. That's why we give so much, you know? Too much. I like you too much. Great guy. They lifted sanctions on Iran in exchange for getting nothing, and sent the regime tens of billions of dollars to fund terror and death all over the world. And they laughed at him. They laughed at our leader. And they're still laughing at our leader. They thought him a fool. And they made nothing but trouble ever since, including the funding of October 7th, one of the worst days ever in the history of the Middle East. Horrible day. Biden removed the Houthis from the list of foreign terrorist organizations, even while missiles and drones were being launched right here at your beautiful city of Riyadh, and launched at ships if they happened to be sailing in the wrong location. The Biden administration's extreme weakness and gross incompetence derailed progress toward peace, destabilized the region, and put at risk everything we had worked so hard to build together. And when you think of the great achievements that you've made, to do it in light of a pretty hostile administration, an administration that was not a believer, it makes your achievements even greater. Makes them even greater, you know that. But in a few short months since taking office, we have achieved the swift return of American strength at home and abroad, now working with the vast majority of people in this region who seek stability and calm. Our task is to unify against the few agents of chaos and terror that are left and that are holding hostage the dreams of millions and millions of great people. The biggest and most destructive of these forces is the regime in Iran, which has caused unthinkable suffering in Syria, Lebanon, Gaza, Iraq, Yemen, and beyond. There could be no sharper contrast with the path you have pursued on the Arabian Peninsula than the disaster unfolding right across in the Gulf of Iran. Think of that. They wanted to name it that. I said, they're not going to let them do that. Do you mind if I stop that? I stopped it. We're not going to let that happen. While you have been constructing the world's tallest skyscrapers in Jeddah and Dubai, Tehran's 1979 landmarks are collapsing into rubble and dust. They had it going for a little while under a much different system, but those buildings are largely falling apart, falling down, while you're building some of the world's biggest and most incredible infrastructure projects, buildings, all sorts of things you're building that nobody's ever even seen before. Iran's decades of neglect and mismanagement have left the country plagued by rolling blackouts lasting for hours a day. All the time you hear about it. While your skill has turned dry deserts into fertile farmland, Iran's leaders have managed to turn green farmland into dry deserts. as their corrupt water mafia, it's called it the water mafia, causes droughts and empty riverbeds. They get rich, but they don't let the people have any of it. And then, of course, there's the key difference at the root of it all. While the Arab states have focused on becoming pillars of regional stability and world commerce, Iran's leaders have focused on stealing their people's wealth to fund terror and bloodshed abroad. Most tragic of all, they have dragged down an entire region with them. Countless lives were lost in the Iranian effort to maintain a crumbling regime in Syria. Look at what happened with Syria. In Lebanon, their Hezbollah proxies have pillaged the hopes of a nation whose capital, Beirut, was once called the Paris of the Middle East. Can you imagine? All of this misery and so much more was entirely avoidable, absolutely avoidable. And Mohammed knew that. He knew that. Smart people knew that. If only the Iranian regime had focused on building their nation up instead of tearing the region down. Yet I'm here today not merely to condemn the past chaos of Iran's leaders, but to offer them a new path and a much better path toward a far better and more hopeful future. As I've shown repeatedly, I am willing to end past conflicts and forge new partnerships for a better and more stable world, even if our differences may be very profound, which obviously they are in the case of Iran. I have never believed in having permanent enemies. I am different than a lot of people think. I don't like permanent enemies, but sometimes you need enemies to do the job, and you have to do it right. Enemies get you motivated. In fact, some of the closest friends of the United States of America are nations we fought wars against in generations past, and now they're our friends and our allies. I want to make a deal with Iran. If I can make a deal with Iran, I'll be very happy if we're going to make your region and the world a safer place. But if Iran's leadership rejects this olive branch and continues to attack their neighbors, then we will have no choice but to inflict massive maximum pressure, drive Iranian oil exports to zero like I did before. If you know that, they were a virtually bankrupt country because of what I did. They had no money for terror. They had no money for Hamas or Hezbollah, and take all action required to stop the regime from ever having a nuclear weapon. Iran will never have a nuclear weapon. But with that said, Iran can have a much brighter future, but will never allow America and its allies to be threatened with terrorism or nuclear attack. The choice is theirs to make. We really want them to be a successful country. We want them to be a wonderful, safe, great country, but they cannot have a nuclear weapon. This is an offer that will not last forever. The time is right now for them to choose. Right now, we don't have a lot of time to wait. Things are happening at a very fast pace. They're happening right here. They're happening at a very fast pace. So they have to make their move right now, one way or the other. Make your move. As I said in my inaugural address, my greatest hope is to be a peacemaker and to be a unifier. I don't like war. We have the greatest military, by the way, in the history of the world. You know, I rebuilt our military in my first 4 years and rebuilt it into the most powerful military there is. And you saw that when I knocked out ISIS in 3 weeks. People said it would take 4 years, 5 years. I did it. We did it in 3 weeks. Just days ago, my administration successfully brokered a historic ceasefire to stop the escalating violence between India and Pakistan. And I used trade to a large extent to do it. I said, fellas, come on, let's make a deal. Let's do some trading. Let's not trade nuclear missiles. Let's trade the things that you make so beautifully. And they both have very powerful leaders, very strong leaders, good leaders, smart leaders. And it all stopped. Hopefully it'll remain that way, but it all stopped. I was very proud of Marco Rubio and all of the people that worked so hard. Marco, stand up. What a great job you did on that. Thank you, J.D. Vance. Marco. The whole group worked with you, but it was a great job. And I think they're actually getting along. Maybe we can even get them together a little bit, Marco, where they go out and have a nice dinner together. Wouldn't that be nice? But we've come a long way, and that's going to be, millions of people could have died from that conflict that started off small and was getting bigger and bigger and bigger by the day. I've also been working relentlessly to end the terrible bloodshed between Russia and Ukraine, and very importantly, talks are being held in Turkey later this week, probably on Thursday, and they could produce some pretty good results. Our people are going to be going there. Marco's going to be going there. Others are going to be going, and we'll see if we can get it done. 5,000 people, young people for the most part, soldiers from Ukraine, soldiers from Russia. They're not from here and they're not from the United States, but they're souls. They're souls. I think mostly they're young, beautiful souls that left their parents waving goodbye, left their brothers and sisters. Goodbye, I'll see you soon. And they got blown to pieces. 5,000 on average a week are dying. And people are dying elsewhere in the region, but tremendous numbers like we haven't seen since World War II are dying, and I want to stop it. I want to stop it. It's a horrible war. Would have never happened if I were president. That's a war that would have never happened. October 7th would have never happened if I were president, because Iran had no money to pay Hamas or anybody else. They had no money. They were not looking to take care of them. They had to take care of themselves. They had no money. We stopped their oil effectively with the embargoes and sanctions. But let me take this opportunity to thank the Kingdom of Saudi Arabia for the constructive role that you've played in facilitating the Ukraine talks. And it really is, you've been amazing. You've made everything available to us. Thank you very much. Thank you. And if we get that settled, we'll pay a special tribute to what you've done. You really did lay a great groundwork. Thank you very much. Appreciate it. The West should not be dragging itself backward into another endless war in Europe, yet another endless war. We should stop the killing and work together to address the biggest long-term threats as one unbeatable team. Think of us as an unbeatable team. I mean, when you look at what you've done here, that's much more difficult than stopping stupidity. Think of it. It's stupidity. What you've done is much more difficult, and you did it better than anybody else has ever done it. As President of the United States, my preference will always be for peace and partnership whenever those outcomes can be achieved. Always. It's always going to be that way. Only a fool would think otherwise. In recent years, far too many American presidents have been afflicted with the notion that it's our job to look into the souls of foreign leaders and use U.S. policy to dispense justice for their sins. They loved using our very powerful military, and now it's really the most powerful it's ever been. We just are getting a budget approved, $1 trillion, highest budget we've ever had in history for military, $1 trillion. And we're getting the greatest missiles, the greatest weapons. And, I hate to do it, but you have to do it because we believe in peace through strength. You have to have the strength, otherwise bad things could happen. But hopefully we'll never have to use any of those weapons. Seems to be an awfully big waste of money if you're never going to use them, but hopefully we'll never have to use them, because the destructive power of some of those weapons are like nobody's seen before. I believe it is God's job to sit in judgment, my job to defend America and to promote the fundamental interest of stability, prosperity, and peace. That's what I really want to do. I will never hesitate to wield American power if it's necessary to defend the United States or to help defend our allies. And there will be no mercy for any foe who tries to do us or them harm. We will have no mercy. They understand that. That's why I've been pretty lucky. A lot of people think, you know, he's looking to fight. He's looking to fight, and things get settled. It's an amazing thing when they really think you mean it. But we do. We have the greatest military, the strongest military, stronger than any. Nobody's even close. We have the best weapons in the world, but we don't want to use them. If you threaten America or our partners, however, then you'll be faced with overwhelming strength and devastating force. We have things that you don't even know about, you don't hear about, and if you did, you'd say, wow. In recent weeks following repeated attacks on American ships and freedom of navigation in the Red Sea, the United States military launched more than 1,100 strikes on the Houthis in Yemen. As a result, the Houthis agreed to stop. They said, we don't want this anymore. It's the first time you've heard that from them, too. They're tough. They're fighters. But just days ago, we were asked to cease targeting commercial. They were not going to be targeting commercial ships in any way, shape, or form, or anything American. And they were very happy that we stopped. But we had 52 days of thunder and lightning like they've never seen before. This was a swift, ferocious, decisive, and extremely successful use of military force. Not that we wanted to do it, but they were shooting down ships. They were shooting at you. They were shooting at Saudi Arabia. We don't want them shooting at Saudi Arabia if that's okay. So we hit them hard. We got what we came for, and then we got out. Since January 20th, the U.S. military has terminated 83 terrorist leaders operating across Iraq, Syria, and Somalia, including ISIS's #2 global leader. You read about that just recently. With the help of Pakistan, we apprehended the ISIS terrorists responsible for the attack on 13 American service members at Abbey Gate, that horrible, horrible disaster. During this Afghanistan withdrawal, you know, that's another thing that we don't even think about so much anymore. 13 died, but 42 were horribly wounded. But hundreds of people died overall, because I count the people on the other side. Hundreds of people just grossly incompetent. It's probably why Putin decided to go into Ukraine, something he never would have done if I were president. But we wouldn't have had the problems of October 7th if I were president. We wouldn't have had Ukraine, Russia if I were president. We wouldn't have had Abbey Gate, because there wouldn't have been any reason we were getting out, but we were getting out with dignity and with strength and power. But the way they got out was not good. I think it was the most embarrassing moment in the history of our country. And we've been working tirelessly to bring back all hostages held by Hamas. We brought back a lot already, but we're bringing back more. This weekend, we successfully negotiated the release of the last American hostage, Edan Alexander. Just came out a few hours ago, and we continue to work to get that war ended as quickly as possible. It's a horrible thing that's taking place. All civilized people must condemn the October 7th atrocities against Israel, which would never have happened again if you had probably a different president, but definitely if you had me as president. The people of Gaza deserve a much better future, but that will or can not occur as long as their leaders choose to kidnap, torture, and target innocent men, women, and children for political ends. The way those people are treated in Gaza, there's not a place in the world where people are treated so badly. It's horrible. After years of suffering, two of the nations most ravaged by terror are finally beginning to end their long nightmares under the new generation of leaders. In Lebanon, where a friend of mine has just become the ambassador. He's going to be great. I said, you know, that could be a very dangerous job. He said, I was born there. I'm Lebanese. I love that country. I said, but it's very dangerous. You know, this is a friend of mine from New York. I said, but it's very dangerous. Are you sure you want to do it? I never thought of him as being a warrior, but he is a warrior. He loves his country. He said, if I'm injured or die, I'm dying for a country that I love. He grew up there. It's horrible what's happened in Lebanon, but you have a great ambassador, I can tell you that. In Lebanon, which has been endlessly victimized by Hezbollah and their sponsor, Iran. A new president and prime minister have brought the first real chance in decades for a more productive partnership with the United States, and we're going to work with their new ambassador and everybody else, Marco, and we're going to see if we can really help them out and let them get over that very high grid that they're going to have to get over. My administration stands ready to help Lebanon create a future of economic development and peace with its neighbors. They have tremendous people in Lebanon. Doctors, lawyers, great professional people. I hear it so many times. Likewise in Syria, which has seen so much misery and death, there is a new government that will hopefully succeed in stabilizing the country and keeping peace. That's what we want to see in Syria. They've had their share of travesty, war, killing, many years. That's why my administration has already taken the first steps toward restoring normal relations between the United States and Syria for the first time in more than a decade. And I'm very pleased to announce that Secretary Marco Rubio will be meeting with the new Syrian foreign minister in Turkey later this week. And very importantly, after discussing the situation in Syria with the Crown Prince, your Crown Prince, and also with President Erdogan of Turkey, who called me the other day and asked for a very similar thing, among others, and friends of mine, people that I have a lot of respect for in the Middle East. I will be ordering the cessation of sanctions against Syria in order to give them a chance at greatness. Oh, what I do for the Crown Prince. The sanctions were brutal and crippling and served as an important, really an important function, nevertheless, at the time. But now it's their time to shine. It's their time to shine. We're taking them all off, and they're going to have, I think they're going to have, based on the people and the spirit and everything else that I'm hearing about. So I say good luck, Syria. Show us something very special like they've done, frankly, in Saudi Arabia, okay? They're going to show us something special. Very good people. Everywhere we can, my administration is pursuing peaceful engagement, offering a strong and steady hand of friendship to all that will take it in good faith. Together, we have made unprecedented strides and tremendous progress, and we're still just at the dawn of the bright new day that awaits for the people of the Middle East, the great, great people of the Middle East. If the responsible nations of this region seize this moment, put aside your differences and focus on the interests that unite you, then all of humanity will soon be amazed at what they will see right here in this geographic center of the world. It really is. It's like a center of the world and the spiritual heart of its greatest faiths. For the first time in 1,000 years, the world will look at this region not as a place of turmoil and strife and war and death, but as a land of opportunity and hope, just like you've done right here, a cultural and commercial crossroads of the planet. Security and stability will lift millions into lives of safety and success, and the nations of this region will be free to realize your highest destinies, honor your proud histories, harness amazing new opportunities, and bring incredible glory to Almighty God. People will come from all over the globe to be inspired by the cities you build, the businesses you create, the technologies you invent, and the beauty, talent, and potential you unleash right in the hearts of your citizens. Each of you will be able to take tremendous pride in the legacy you will leave to your children, because you will have given them the ultimate blessings of prosperity and peace, so important. In the United States, we've launched the golden age of America. It's the golden age. We see it. We see it with all that money, trillions and trillions and dollars pouring in, hundreds of thousands of jobs coming in with it. And with the help of the people of the Middle East, the people in this room, partners throughout the region, the golden age of the Middle East can proceed right alongside of us. We will work together. We will be together. We will succeed together. We will win together. And we will always be friends. Thank you. So, Mohammed, I want to thank you again very much for having me. And as a representative of what I think is the greatest nation in the world, we are with you all the way, and you have a tremendous future. Thank you very much. And please pay my respects to your father. Thank you very much. Thank you.
President Trump concluding remarks at the Saudi-U.S. Investment Forum in Riyadh, Saudi Arabia, of course, part of his multi-day trip to Middle Eastern countries, Saudi Arabia being the first. We just heard from the president there on a wide range of subjects that we'll begin to analyze here on Balance of Power on Bloomberg Radio. I'm Kaylee Lyons in Washington. Much of the president's remarks centering around geopolitical issues and conflicts in the Middle East. The president making some news saying that he will order the end of sanctions on Syria as his government and members of it prepare to meet with Syrian officials after the toppling of the Assad regime. We also heard plenty on Gaza, on Lebanon, on the Houthis as well. Some warning words for Iran. The president saying that there is a choice to be made and that Iran can never have a nuclear weapon. But of course, geopolitics are only one element of the president's trip to the Middle East. The other is he's there to bring in the money. He wants to draw in foreign investment to the U.S., and indeed he did get some pledges of that from Saudi Arabia today. The White House touting $600 billion in commitments from the Saudi government, though the Crown Prince, Mohammed bin Salman, who right now is on stage with President Trump as they exit the stage here, he, of course, spoke before him, says that they are going to try to get that number up to $1 trillion, which was President Trump's goal. So we want to get more on all of this now and turn to Bloomberg Washington correspondent Tyler Kendall, who's here with me in the Washington, D.C. studio. So obviously he wanted to talk about the money, Tyler. It does seem that he's getting a good deal of it, though at least what's been committed so far, we already knew the Saudis were going to be spending in the U.S. over the next 4 years.
Right, exactly. When President Trump was inaugurated, the Crown Prince had pledged that there would be $600 billion investment and trade boosting into the U.S. over 4 years. And it was interesting to hear President Trump here really tout his relationship with the Saudi Crown Prince and really focus on that U.S.-Saudi Arabia relationship, calling it a partner like no other. Of course, this is his first official state visit abroad, and you'll recall the first foreign leader that called him once he was inaugurated was the Crown Prince. Now, just because this investment wasn't new, we did start to get a few more additional details about exactly where it will be going. It's geared towards energy, defense, technology sectors. We also heard some specifics when it comes to the private sector. The White House telling us that Google, Oracle, Salesforce, AMD, and Uber, so some pretty big names there, will invest $80 billion in cutting-edge technology in both countries. Of course, Saudi Arabia also getting some things in this deal, including $142 billion worth of U.S. defense sales to Saudi Arabia. And Kaylee, I actually was there in February, back in Miami at the Saudi-backed FII summit, where we heard a very similar speech coming from President Trump as he addressed investors and Saudi officials alike. And at the time, he did call for that $1 trillion investment. The Crown Prince today saying that they're going to work on it. But our own Bloomberg Economics says that is very unlikely. That is a very high number to reach. Yeah. Because it kind of counteracts with some of the domestic policies that Saudi Arabia is trying to implement when it comes to their Vision 2030 plan, which is a goal to sort of divest its own economy away from other sectors and diversify it in a sense. And that's going to take a lot of money, but still, of course, $600 billion is a lot. It makes up about 55% of Saudi Arabia's GDP.
Yeah, well, and when we consider those diversification efforts on the part of Saudi Arabia, technology does have a role to play there. And for a lot of technology these days, you need chips, and we understand the U.S. is going to be making some concessions, if you will, on chip sales to Saudi Arabia as well.
Well, people familiar tell Bloomberg News, including our own Anne-Marie Herdern, who's on the ground in Riyadh this week, that they could announce this deal as soon as this week as President Trump makes his tour around the Middle East. It would allow Saudi Arabia access to these cutting-edge chips. And perhaps one of the most important aspects here, though, is that there had been these curbs because of U.S. concerns about this technology falling into the hands of China. And there are still different provisions that are being discussed here, including whether or not the U.S. government could control access to some of these data facilities where we are using these chips and that technology. So they're still ironing out the details here, but it would be considered a really big win for these Gulf states that had been trying to lobby this administration when it came to rescinding the so-called AI diffusion rule, which it appears the Trump team is prepared to do.
All right, Bloomberg's Tyler Kendall with the latest as President Trump continues his journeys in the Middle East. Thank you so much for being here on Balance of Power. And while President Trump seems to be focusing on investment as the I word of the day today, we also are focused on inflation. As we got CPI data today, that came in cooler than expected, just a 0.2% rise month on month on CPI, which suggests that the tariff effect is maybe more muted than initially feared. And we want to get into this now with Bloomberg's Enda Curran, who covers the global economy for us here in Washington. So, Enda, obviously the headline in and of itself was cool and noteworthy, but when we look at the different kind of components and the areas in which we thought you might be seeing the tariff impact show up the most, we did see that in things like appliances, for example, but not so much in other areas.
No, the headline takeaway, especially when you consider April was the month Liberation Day was announced, and of course all these big tariffs, biggest increase in a century, went on imported goods. You might think, wow, April inflation data might capture it. It didn't really, as you mentioned, Kaylee, the likes of, say, apparel and new cars, nothing really showing up there. There are some hints of it inside the data. Furniture, for example, typically imported from abroad, and appliances. Those prices shot up, so maybe a signal of what's to come. But I think the bigger picture is April is only one part of this inflation story.
Well, and considering the way in which we've seen tariffs taken down, specifically between the U.S. and China, just in the last few days now, significantly lower, does that mean that the May figures may not see the kind of pressure that is anticipated, or is there enough of a kind of lagged effect, if you will, that we'll just be feeling the initial tariffs come May, and it's the later data that may benefit from the reduced tensions or escalation?
I mean, it's getting messy, Kaylee, trying to keep track of all of this, but what we do know is there's a baseline tariff of 10% on everybody. There is, of course, the sectoral tariffs on aluminium, steel, and cars, for example, and then you have the tariffs on China, which are still, depending on which estimate, maybe in the 40s, the average effective tariff on stuff coming from China. So there is going to be pressure on prices on goods that retail outlets say they are warning they will need to pass on to consumers. And we don't know the extent. Can they swallow some of it in their margins? Will their manufacturers in China maybe take some of the hit on this? Like, there's different ways this can be spread along the supply chain, but economists are still saying there is inflationary pressure in the pipeline from tariffs. I should say as well, we're currently in the phase of running down inventory that was bought before tariffs. And once that is also run down, then we're into proper tariff goods.
Well, that's a very good point. And of course, all of that has to be under consideration by the Federal Reserve as they consider what kind of economic dynamics they're going to have to respond to if there's greater risks to growth or greater upside risk to inflation. Does this data do anything really, Enda, to suggest that the Fed's going to feel the need to move off the block anytime soon?
I think for borrowing costs, it probably doesn't nudge the needle much either way. The Fed seem very happy to be sitting where they're at. Last week when Chairman Powell came out and spoke to the public, he said it's too early to say. They're going to wait and see how this tariff policy plays out. He was proven quite right given the news over the weekend, by the way. So you imagine the Fed are on the sidelines, but if you're really in the camp that there's room for borrowing costs to come down, well, inflation is clearly heading in the right direction, and if the economy continues to slow over the coming months, as economists predict, perhaps at some point we will see a Fed rate cut, but not right here, right now, based on today's numbers, I think.
All right, Bloomberg's Enda Curran running us through the latest data and its implications. Thank you so much. And of course, as we consider the state of the economy, the tariff policies from the president and the tax policy from the president, it all does have major political implications as we look ahead to the midterm elections in 2026. That certainly is on the mind of lawmakers on Capitol Hill as Republicans get ready to mark up some key portions of the massive budget reconciliation legislation this afternoon and on to the evening, including cuts to Medicaid, but also cuts to taxes. And it's going to be something that a lot of moderates And SALT caucus members, people who exist in swing districts, are going to have to figure out whether or not their constituencies actually want, knowing Republicans want to keep the House in 2026, where every seat will be up for grabs. And the Senate is another question, too, as there's a number of key seats that are in play, including one in Michigan, thanks to the retirement of Senator, or the planned retirement, that is, of Senator Gary Peters, the Democrat. It's kicking off a contest for his seat, who will sit there next. And there are a number of Democrats already in this primary. Of course, current U.S. Congresswoman Haley Stevens, former Michigan Speaker Joe Tate, State Senator Mallory McGuire, and our next guest here on Balance of Power, Abdul El-Sayed, Ed, is joining us as well. He is, of course, a Democratic candidate for Senate in the state of Michigan, and we appreciate your time and joining us here on Bloomberg, sir. When we consider the legislation that is currently underway on Capitol Hill, the idea that it will provide some tax breaks to those who, say, work on tipped income or work overtime hours, they won't see their taxes go up as a result of the 2017 tax cuts expiring, but knowing also that there will be some people who may get kicked off Medicaid rolls. On net, what does it mean? How does it play in a state like Michigan?
You know, I think on net, it's a disaster. I think the points that you made about those particular tax breaks, I agree with them. They're just a fig leaf, though, for what will ultimately be major Medicaid cuts that'll drop 500,000 Michiganders and millions more across this country off of Medicaid. And I just want to be clear, right? We talk about Medicaid as a health insurance program for the poor, but 1 in every 2, every other kid in Michigan is insured via Medicaid. And they're talking about work requirements. I just want you to think about this. Are we going back to an era of child labor and we're going to make kids work for their Medicaid? This makes no sense. The real folks who are going to get the biggest tax breaks tend to be the billionaires who Donald Trump seems to want to give an opportunity every single moment he can. I mean, it's as if the stock tip that he gave them just before he pulled back on his disastrous tariffs weren't enough. Now he wants to cut their taxes. And meanwhile, he's out in the Middle East accepting a gift of, what, a $400 million airplane. And like, you got to question, the dude really likes golden toilets. Does this airplane have golden toilets too? I mean, this is just it's a disaster for working people across my state and a disaster for working people across the country.
And I would point out for our audience who may not be able to spot this, I do believe that is a Medicare for All book that is on the bookshelf behind you as you have this conversation. What is then the appropriate way to address issues around entitlements, knowing that financially there's an argument that these are not going to be sustainable for much longer, that there is, of course, an impetus to cut spending, to rein in the debt and deficit. If you were to sit in the U.S. Senate, how would you suggest fixing that problem if you don't want to take away benefits from those who need it?
You know, to me, the real question is sustainability for the average family in Michigan. And I think they're watching as their grocery prices are going through the roof. They're watching as they're worried about falling into debt simply for going to see a doctor. They're worried about whether or not they're going to be able to have a job next year, let alone tomorrow. They're worried about whether or not their kid's school is a place that's educating that kid for the future. And right now, they're finding it all deeply unsustainable. Now, the way that we finance government too often has focused on the well-being of the Fortune 500 rather than the well-being of the 350 million of us who make this country what it is. And so to me, my vision for government is one where the everyday American worker understands that their life in the richest, most powerful country in the world is, in fact, sustainable. And that we need to make decisions about where we invest our dollars to be building toward that sustainability. You know, to everybody watching, to me, we all know that the engine of an economy is people, right? It's people having incredible ideas and opportunities to build that. And to me, that looks like an economy built on small businesses. It's an economy where rather than passing tax cuts for the biggest companies, we're making it easier to build and scale and grow a small business that takes its wealth and puts it back into the local community. There's just a difference in vision here, but we can, in fact, do the things that